So we're going to continue with our discussion on the important 30 questions. We're done with 10 questions in the last session, and I'm going to start off with the rest of the questions now. We're done till the salaries chapter. We're going to start with this question in front of us, which is from the IFHP discussion. All right. This is question number 11. Question number 11 from IFHP chapter. Okay. IFHP chapter, we'll have to read the whole question. We'll read it once, we'll understand what exactly has happened over here, and then we'll work it out. It's a simple question. There are just a couple of adjustments over here, which I wanted to remind you all about through this question. Let's give it a reading. The question says, Mr. Rocks, a citizen of the country Y, is a resident but not ordinarily resident. Guys, he is RNOR. So what kind of incomes will we tax for him? Number one, we will tax for him all Indian incomes, that is incomes which are earned in India, incomes which are received in India, and we will also tax for him incomes from businesses which are controlled in India and incomes from professions which are set up in India. Now, during the financial year 2021. So in this question, we are talking about previous year 2021. That is, we're talking about assessment year 21-22. He owns 2 house properties in country Y. One is used as his residence. Another house property is rented for a monthly rent of $18,000. Fair rent of the house property is $20,000, and the value of one country Y dollar may be taken as 78 rupees. So the question says our assessee is an RNOR, and this assessee in country Y, in some foreign country, in country Y, this assessee has 2 houses. Let me call them as house 1 and house 2. This house number 1 is self-occupied for residence purpose, and house number 2 is let out by this assessee. Okay, this is the information given to us in the first para. Then they tell us that he took ownership and possession of a flat in Delhi. Okay, so he also has a flat in Delhi, and on 1st October 2020, which is used for self-occupation while he is in India. So this Delhi house is a self-occupied house. Okay. The flat was used by him for 3 months at the time when he visited India during the previous year, 2021. Municipal value is 4,58,000 per annum. Fair rent is 3,60,000. He paid property tax of 13,800 and 2,800 as sewage tax to Municipal Corporation of Delhi. Then he had taken a loan of 18 lakhs at 9.5% from HDFC Bank on 1st August 2018 for purchasing this flat. No amount is repaid by him till 31st March 2021. So this entire information over here is given to us about the Delhi house. Then he also had a house in Bangalore. So he has one more house. He has this Bangalore house, which is let out on a monthly rent of 40,000 rupees. Fair rent is 4,58,000 per annum. Municipal value is 3,58,000 per annum, and the standard rent is 4,20,000 per annum. He had taken a loan of 25 lakhs at 10% from one of his friends residing in country Y for this house. Municipal tax of 5,400 is paid by him in respect of this house during the previous year 2021. Compute the income chargeable from house property of Mr. Rocks for the assessment year 21-22. Is the question clear to us? Yes, there is this assessee. This assessee in country Y, this assessee is an RNOR, by the way, and we are doing the calculation for previous year 2021, that is assessment year 21-22. This is a target year for us. And in country Y, he has house 1 and house 2, one house self-occupied, one house let out. Delhi house is self-occupied, and this Bangalore house is let out by him. This is the information which they have given to us in the question. This last paragraph over here, this is all about this let out Delhi house. Okay, now listen, he is RNOR. So what kinds of incomes will you tax for him? You will tax for him Indian incomes. Number one, Indian incomes means incomes which have a source in India and incomes which are received in India. And number two, you will also tax for him business incomes from businesses which are controlled in India and professional incomes from professions which are set up in India. Now listen, for this RNOR, will I consider country Y houses? Will I consider country Y houses? No, I will not, because these houses, the source is outside India. Also, the income is not received in India, and also this is not business income, this is not professional income. So country Y houses, I will not even consider. Is this part clear? He is RNOR. I will consider only those incomes which have a source in India or received in India. This is neither source in India, this is not received in India. This is source in country Y, this is source in a foreign country. It's a foreign property. So therefore, I'm not even going to consider it. So my entire scope of discussion will be regarding one Delhi house and one Bangalore house, one self-occupied house and one let out house. This is our basic analysis of this question. Okay, this in this country Y house, if you see, neither is the source in India, even the source is outside India, even the income is received outside India. So neither is it having a source in India, nor is it received in India. Neither is it having a source in India, nor is it received in India. Alright, so therefore countrywide property I will not even consider. So my entire scope of discussion will be number one, the Delhi house, and number two, the Bangalore house. So the Delhi house over here happens to be self-occupied house. So we will consider this self-occupied house property first. Now, how do you start self-occupied property calculation? You start with NAV, right? And NAV which is always 0. Then from this you will subtract deductions under section 24. Now it's a self-occupied property. How many deductions will you have? Only one deduction you will have, and that is interest on borrowed capital. Now, as soon as you write interest on borrowed capital, immediately two things should come to your mind. One is the pre-construction interest and the other is a current year interest. Right now, we are in previous year 2021. What do you think? In this question, for the Delhi house, for the self-occupied Delhi house, do we have pre-construction interest? Do we have pre-construction interest? This assessee had bought this Delhi house on 1st October 2020. He took ownership on 1st October 2020. For this house, he had borrowed a loan of 18 lakh at 9.5% from HDFC Bank on 1st August 2018. So are you noticing, even before this house was in existence, even before that loan is existing? So pre-construction alone is existing, guys. So can I conclude that there is pre-construction interest? Yes, of course, I can conclude that there is pre-construction interest. The whole reason why I'm working this question out for you is for pre-construction interest only. Because in the whole of IFHP chapter, if you see, the only difficult adjustment is pre-construction interest. If you know the pre-construction interest adjustment, the rest of it easily you can handle. Right, guys? So let me discuss with you pre-construction interest. I will simplify it for you in the form of 6 simple steps. Okay, those 6 simple steps you can blindly follow in each and every question relating to pre-construction interest. 100% you will get a perfect answer. Okay, now what are the 6 steps? What is your first step? What is your first step? Your first step will be the date of completion of construction. Date of completion of construction. When did the construction get complete? Here, when did my assessee get the property? On 1st October 2020. This is my first step. The second step will be the preceding 31st March. The preceding 31st March or the date of repayment of loan, whichever is earlier. So what's the preceding 31st March here? 31st March 2020. The question does not even talk about repayment. The question says no amount is repaid till 31st March 2021. No amount is repaid. So therefore, date of repayment we don't even have. So I'll only consider the preceding 31st March. Priya is asking us how to find pre-construction interest. I just told you, Priya, that the house was acquired on 1st October 2020. Even before 1st October 2020, loan is existing. From 2018 itself, loan is existing. So pre-construction, even before the house is ready, pre-construction, the loan is existing, right? Compare 2020 and 2018. Before 2020 itself, loan is existing. So therefore, yes, there is pre-construction interest. Okay, understood, Priya? Come on, give me a quick response. Yes, even before 1st October 2020, loan is existing. That would be your judgment. That is how you will be able to identify that there is pre-construction interest. Even before the house is ready, even before that, the loan is existing. That would indicate that there is pre-construction interest. Now, coming to step 3. So, step 1 is the date of completion of construction. Step 2 is preceding 31st March or date of repayment, whichever is earlier. Step 3 is your pre-construction period. Step 3 is your pre-construction period. Now, what is your pre-construction period? Your pre-construction period will start on the date of borrowing and it will end on the step 2 date. Pre-construction period will start on the date of borrowing and will end on the step 2 date. Now, what is the date of borrowing? When did we borrow the loan over here? We borrowed it on 1st August 2018. And what is the step 2 date? The step 2 date is 31st March 2020. Now, what is this period? How long is this period? How long is this period? How many months is this period? This is going to be 20 months. 1 year and 8 months, right? So basically 1920 fully, and if you look at 1819, August, September, October, November, December, Jan, Feb, March, so 12 months, 8 months, this period is totally 20 months. Now comes step 4. For this pre-construction period, in this period of 20 months, what is a pre-construction interest? In this period of 20 months, how much interest have we incurred? See, what is the amount of the loan? The amount of the loan is 18 lakhs. 18 lakhs loan into 9.5% interest. This is for 1 year, but I need for 20 months. So 20 by 12. So how much is this interest going to be? What is the total pre-construction interest? The total pre-construction interest is going to be 2,85,000. But this pre-construction interest you're going to allow across how many years? This pre-construction interest you're going to allow across 5 years. So which means every year, how much are you going to allow? Every year you're going to allow 57,000 rupees. But never end your answer here. Please check what are the 5 years for which it will be allowed. Once the house is ready, this year onwards, you will start allowing the pre-construction interest. Which year is this? When is the completion of construction? Which year house is ready? House is ready in previous year 2021. So 2021, 21, 22, 22, 23, 23, 24, and 24, 25. So these are the 5 years in which you will allow this pre-construction interest. The current year in this question is 2021, which is in this list. So therefore, current year, I will get the pre-construction interest deduction. I will get. These are the 6 simple steps that you can follow for pre-construction interest. Your first step is date of completion of construction. That is, when did the construction get complete? Here it got completed on 1st of October 2020. Your second step will be the preceding 31st March. Just before 1st October 2020, what is the preceding 31st March? Preceding 31st March or the date of repayment of loan, whichever is earlier. Preceding 31st March or date of repayment of loan, whichever is earlier. Saranya, did you understand the second step? The preceding 31st March. Just before this, what is the preceding 31st March or date of repayment, whichever is earlier, preceding 31st March or date of repayment, whichever is earlier. Then you will see the pre-construction period. The pre-construction period will start on the date of borrowing and it will end on the step 2 date over here. Now for this period, you will have to find the pre-construction interest. This pre-construction interest, you will get a deduction across 5 years. Now which are the 5 years and is the current year in this list of 5 years? Yes. So current year, I will get pre-construction interest of 57,000. But never stop with pre-construction interest. I have to discuss about one more thing. I also have to discuss about current year interest. So what is going to be a current year interest? The full loan is outstanding. They are saying 18 lakh is outstanding. 18 lakh into 9.5% interest. So what is the current year's interest? The current year's interest is going to be 1,71,000. So if you see, pre-construction interest is 57,000. Current year interest is 1,71,000. So what is the total interest for this year? The total interest for this year is 2,28,000, which we will have to limit to either 2 lakh or we will have to limit to 30,000 because it is a self-occupied property. When can you apply the 2 lakh limit? You can apply the 2 lakh limit only if 3 conditions are fulfilled. Number 1, the date of borrowing. When did you borrow the loan? You borrowed the loan on or after 31st, or you should have borrowed the loan on or after 1st April 1999. You should have borrowed the loan on or after 1st April 1999. What is second condition? The second condition is that you should have borrowed the loan for purchase or construction of the property, not for repair, reconstruction, renewal and all. The third condition is that the construction should be completed within 5 years. When did you borrow the loan? From the date of borrowing the loan, within 5 years, you must have completed the construction. I have 3 conditions. All these 3 conditions should be fulfilled. Only then you can take the 2 lakh limit. Now, in this question, if you see the date of borrowing, was it on or after 1st April 1999? Yes, the loan was borrowed in 2018. This condition is fulfilled. Yes, the loan was borrowed for the purpose of purchasing this flat only. Even this condition is fulfilled. Was the construction completed within 5 years? See, the loan was borrowed in 2018. The construction was completed in 2020. So was it completed within 5 years? Yes, it was completed within 5 years. So all our conditions are fulfilled. So what will be the maximum limit over here? The maximum limit over here is going to be 2 lakhs. So how much total interest deduction will you enjoy in this question? You will enjoy total interest deduction of 2 lakh rupees. So your loss from house property from the self-occupied unit is going to be 2 lakh rupees. Now, before I proceed to the letter property, there is one little thing which I still have to discuss with you. But before I come to that thing also, till here you should be clear. Pre-construction interest, current year interest, you got to think about both. Whenever you come to interest on borrowed capital, you never straight away start calculating interest on borrowed capital. You always first check. You always first pause and check that, do we have pre-construction interest or not? Only then you calculate current year interest. Pre-construction interest, 6 steps I've given you. First step, date of completion of construction. Second step, preceding 31st March or date of repayment, whichever is earlier. Third step, pre-construction period, which always starts on the date of borrowing and ends on the step 2 date. Durga Prasad, I'll come to your question. Give me a minute. Step number 4, pre-construction interest will be the interest that we are incurring for this particular period. And step number 5 will be nothing but pre-construction interest divided by 5. This is going to become a pre-construction interest. This is what I'm going to get across these 5 years. Which 5 years? The 5 years will start from when? Once the construction is complete, from this year onwards, the 5 years will start. So 2021 onwards, total 5 years, you will get 57,000 deduction each year for 5 years. years. This is a pre-construction interest deduction. But never stop with pre-construction interest. We also have current year interest. 18 lakh full loan is outstanding, 9.5% per annum, 1,71,000. So the total interest for this house, for this one house, total interest was 2,28,000. Now we have two limits, 2,30,000. We saw all our conditions are fulfilled. Therefore, we gave it the 2 lakh limit. So the total interest deduction was 2 lakhs. So the loss from house property is 2 lakhs. Then here, does it make sense to everybody? Yes. Can I discuss with you that little thing which is still pending in this part? Till here, you've understood, right? Now listen to me very, very carefully. See, we're talking about previous year 2021, right guys? We're talking about previous year 2021. When does 2021 start? It will start on 1st April 2020. It will end when? It will end on 31st March 2021, right? Now in this year, when did the house get ready? The house got ready only on 1st October 2020, the house got ready. So don't you think in reality, even this is pre-construction period? Don't you think in reality, even in this period, actually construction is still going on? Don't you think the house is ready only on 1st October 2020? So only this is post-construction interest, right? Till this date, the construction is still going on, guys. But listen, why did we not consider all this? There's a reason. Tell me, pre-construction interest we calculated till which date? Tell me, Durga Prasad, pre-construction interest we calculated till which date? Pre-construction period we are ending on which date? On 31st March 2020, right guys? Pre-construction period, you are, see, what is a pre-construction period over here? What have you written? You have written that the pre-construction period will start on the date of borrowing and it will end on the step 2 date, which means pre-construction period you have ended when? You have ended the pre-construction period on 31st March 2020. So before this, before 1st April 2020, everything is pre-construction period. After 1st October 2020, it is post-construction period. Then where will this period go? You're neither putting it under this period, nor will you put under this period. Then where will this period's interest go? Are you understanding the problem which I'm creating in front of you? All these kind of doubts will suddenly start coming in those 3 hours in the examination. Now listen. Listen to what I'm telling you very, very carefully. Sit up straight, everybody, and listen to me. What are the 2 types of interest? Tell me. The 2 types of interest, are they pre-construction interest and post-construction interest, or are they pre-construction interest and current year interest? Do we say post-construction interest? We don't say post-construction interest. We say pre-construction interest and current year interest. So pre-construction interest is ending on this date. Pre-construction interest is ending and the rest of it is going to be current year interest. So yes, no doubt this period is actually construction period. No doubt in this period actually construction is happening. But if you neither put this period under pre-construction nor you put this period under post-construction, then where will this period go? So therefore, this period can't come under pre-construction because pre-construction is anyways going to end on this date. So you don't have a choice. You will put this period also under current year interest, and that is why we don't call it as post-construction interest. We call it as current year interest. Current year interest means, yes, no doubt a part of the current year construction is happening, but it is still current year or not? It is still 2021 or not? Yes, it is 2021. That is the reason why we call it as current year interest. Is everybody clear with this? Durga Prasad, did you understand this? I am so glad, Durga Prasad, you asked us this question so that I was able to remember to explain this to them. Otherwise, this might have been a doubt which would have stayed persistent. Understood, everybody? So that is why we call it as post-construction interest and current year interest, and not post-construction. We call it as pre-construction interest and current year interest, and we don't use the word post-construction interest. Okay, everybody. So yes, no doubt in this period construction is happening, but this is still current year. So therefore, this period will enter into current year interest. Okay, so this was our discussion regarding the Delhi house, guys. Now, come on, let us go to the next discussion. Our next discussion is going to be about this Bangalore house, which is a let-out house. So we are going to be working out for Bangalore house, which is a let-out house. Now, tell me, let-out property, how do we generally start? Let-out property, how do we generally start a let-out property? We will start with GAV. We will start with gross annual value. We will start with GAV. So we will, and GAV, how do we calculate? Municipal value, fair rent, standard rent, all that we do. Have they given us all those numbers? Yes, they have given us fair rent, municipal value. All those numbers they have given to us. And did they say that the house was purchased in between the year or not? They haven't even given us any date of purchase of the house. So which means my assessee owns the house for the entire year. So I can do the calculation for the entire year. Very, very simple. How to calculate GAV? My first step, my step number 1, municipal value or fair rent, whichever is higher. Municipal value is 3,58,000. Fair rent is 4,58,000. Out of these two numbers, I'm supposed to pick whichever is higher. Which is higher? 4,58,000 is higher. Then coming to step 2. What step 2, which is also called as reasonable expected rent. This is going to be my step 1 number, which is 4,58,000, or my standard rent number. What is a standard rent number? 4,20,000. So it's going to be step 1 or standard rent, whichever is lower. Which is lower? Clearly 4,58,000 is lower. Then coming to step 3. What is step 3? Step 3 will be our actual rent minus unrealized rent. What is the actual rent number? Guys, one small mistake. Whichever is lower is going to be 4,20,000, right? Anyways, coming to the next step, actual rent minus unrealized rent. What is our actual rent in this question here? Monthly rent is 40,000 per month. So 40,000 into 12, the actual rent is going to be 4,80,000. The question does not talk about any unrealized rent. So 4,80,000 as it is becomes my step 3 number. Then coming to the step 4 number. The step 4 number is going to be your step 2 number or your step 3 number, whichever is higher. Step 2 number is 4,20,000. Step 3 number is 4,80,000. Out of these two numbers, I need to pick whichever is higher. Which is higher, guys? 4,80,000 is going to be higher. Then comes step 5, which is vacancy loss. In this question, we don't have any vacancy loss. The question does not say that the property was vacant during the year and also there's no vacancy loss. So finally, step 6, what will the GAV be? Step 4 minus step 5, which is going to be 4,80,000. This is going to be our GAV for this assessee. So we have the GAV number. We have the GAV number of 4,80,000. Now from this, what do we subtract? We subtract municipal taxes paid. You know the significance of the word paid. I have to make the payment of municipal tax, only then I will get a deduction. See, we have paid municipal tax for the Delhi house. That we will not consider. For the Bangalore house, have we paid any municipal tax? Yes. Municipal tax of 5,400 is paid by him for previous year 2021. Tell me, does it even matter to you that this municipal tax is relating to which year? It doesn't matter. It belongs to which year, that doesn't matter. What matters to us is that assessee has paid the municipal tax. How much municipal tax has he paid in this current year? It doesn't matter that municipal tax is belonging to which year. Irrespective of to which year this municipal tax belongs to, we will only see how much municipal tax was paid during the current year. During the current year, he has paid 5,400. Doesn't even matter it belongs to which year. What matters is it is paid in this current year. So what is the net annual value of this assessee, everybody? 4,80,000 minus 5,400. The net annual value is going to be 4,74,600. From this, we will subtract deductions under section 24. We have totally 2 deductions. Number 1, we have a standard deduction, and number 2, we have interest on borrowed capital. Standard deduction and interest. Standard deduction, you know, it's going to be nothing but 30%. 30% of our NAV number, which is going to be 1,42,380. And now coming to the interest calculation. Now look at the interest discussion very carefully over here. He had taken a loan of 25 lakhs at 10% from one of his friends residing in countrywide. Guys, he has borrowed a loan from his friend. It is not a loan from a bank. It is not a loan from a financial institution. It is not a loan from a housing finance company. Can I still give this interest as a deduction under section 24? Yes, under section 24, it does not matter who the lender is. Even if the lender is not a bank, you can still take a deduction. It does not matter who the lender is. Even if the lender is not a bank, you can still take a deduction under section 24. As long as it is interest on loan, as long as the loan is relating to the house, you can take a deduction on section 24. Even if the lender is not a bank, you can still take a deduction under section 24. Point number 1. Point number 2, who is the lender over here? The lender is belonging to a foreign country. Now, are you aware of section 25? Assessee is a resident. He has taken a loan from his friend relating to a house property in India. The loan is a foreign loan. The loan is from a non-resident. Section 25 will apply. Section 25 says that if you borrow a loan from a non-resident for a house, if it is a foreign loan, then you have to deduct tax at source. Only then I will let you take a deduction under section 24. Otherwise, I will not let you take a deduction under section 24 of the interest. Are you clear with this point, everybody? I'll repeat this one last time. Listen, everybody, once again. whenever, see, we're talking about section 25, okay? Section 25 says that if you have taken the loan from a foreign country, that is, if it is a foreign housing loan, if it is a foreign housing loan, listen everybody carefully, if it is a foreign housing loan, then in that case, whatever interest you are paying for this housing loan, you should deduct tax at source. Only if you have deducted tax at source, only then I will give you section 24 deduction for this interest. Now here, does the question say anything about tax reduction at source? The question doesn't say anything at all. So I will assume that the tax has been deducted at source. I will assume that the tax has been deducted at source. So because the tax has been deducted at source already, anything for me to be done? No, whatever interest is there, I can take that interest and give as a deduction. 25 lakh loan, 10% interest, guys. So what is the interest amount going to be? The interest amount is going to be 2,50,000. Do I have to restrict it to 2 lakh rupees? I don't have to. It is a lettered property, no limit on the interest. So full interest I can take as a deduction. So what is my IFHP from the let out property? It's going to be 82,220. Do we get this number? 82,220. This is going to be your IFHP from the letter property. Now, if you have to conclude from the self-occupied property, how much loss you had incurred. Self-occupied property, you had a loss of 2 lakhs. Remember, self-occupied property, you have a loss of 2 lakhs. Letter property, you have a profit of 82,220. So what is your net number now? Your net number is going to be a loss of 1,17,000. No, yeah, 1,17,780. This is your net loss from house property. This was our very first question in IFHP. This one question itself covers multiple adjustments relating to IFHP. Two important adjustments it majorly covers. First important adjustment is a pre-construction interest adjustment. And the second important adjustment it covers is the section 25. Section 25 is one thing which it has been a really long time since they have tested in the examination. So be prepared in case this comes in the examination, you should be able to handle. When does section 25 apply? Only if you've borrowed a loan from a foreign country. So if it is a foreign loan, then what do you do? If it is a foreign loan, then what do you do? You'll have to deduct tax at source. Only if you deduct tax at source, only then you will get section 24 deduction. Otherwise, you will not get section 24 deduction. Okay, now listen, after this, I'm taking you forward to the next discussion. The next question, I'm taking you forward straight away to the question number 12. Now, here we are going to work out questions on PGBP, pure PGBP related questions. How many do we have over here? Question number 12 is a PGBP question focusing on depreciation. Question number 13 is a PGBP question focusing on 44AE, the presumptive taxation relating to trucks. And question number 14 over here is your typical PGBP question where you have the P&L account and a list of adjustments we have. Okay, now this is going to be our 3 questions from the PGBP discussion. Let us take them up one by one. Coming to question number 12 first. Question number 12, this is from your, this is all relating to your depreciation adjustment. Listen as carefully as you can through this particular question. Multiple concepts relating to depreciation, especially additional depreciation, will get revised for you. Okay, let us give it a reading. Questions like these, only one reading is all what you can afford in the examination. That one reading itself has to be done so perfectly that you don't even have to reread the question. Because if you're going to read the question once again, then it indicates that you're unnecessarily spending more time. You're unnecessarily wasting time over there. So one reading has to be proper reading. Come on, read along with me. Compute the quantum of depreciation under section 32 of the Income Tax Act 1961 in respect of the following items of plant and machinery. They're asking you to compute depreciation, okay, which purchased by Gupta Textile Limited, which has set up a manufacturing unit. Guys, it's a manufacturing unit. Even yesterday, if you remember, I had told you that in your intermediate income tax syllabus, if your assessee is a manufacturer, the only special point that the manufacturer will have to keep in mind is additional depreciation, right guys? In a notified backward area of Andhra Pradesh, earlier we used to have special provisions for notified backward areas. We don't have any special provisions for notified backward area anymore. So what if it is a notified backward area? No special provisions anymore as of now. All right, they are asking you to compute the WDV of the block of the assets as at the end of the year. They have given us information. What are they asking us? They are asking us to compute the WDV of the block. Now we have new machinery. Then we have items purchased after 30th November 2019, lorry, forklift truck, new imported machinery. The new imported machinery arrived at the Chennai port on 30th March 2020. It was installed on 3rd April 2020. All other items were installed and put to use during the year ended 31st March 2020. Okay, so this is the information that they have given to us. In this question, they are asking us to find the WDV. WDV, our usual calculation, is what you will be doing, nothing specific in the initial stages. Previous year 1920, that is assessment year 2020. This is the year for us in this question. Previous year 1920, assessment year 2021. Now we'll start. Have they given us any opening WDV? They have not given us any opening WDV because we have started the unit only in the current year. So we don't have any opening WDV. So we only have to start the blocks. So we'll take up the assets one by one. First of all, we have machinery. Tell me, machinery will go to which block, which category of asset? It will go to the plant and machinery category. Plant and machinery, what depreciation rate? Plant and machinery, 15% depreciation rate. So let me open block number 1. Block number 1. Now, in this block number 1, which asset am I talking about? Plant and machinery asset I'm talking about. 15% depreciation I'm talking about. Do we have any opening WDV? On 1st April 2019, do we have any opening WDV? No. Then what do you add? After this, what is your next step? Your next step is add actual cost. Your next step is add actual cost of assets. Assets what? Add actual cost of assets what? Add actual cost of assets acquired. This word acquired has a very important significance which you will understand through this question. Add actual cost of assets acquired. Add actual cost of assets acquired. Now, how many assets have we acquired during the year? Look at these one by one. First of all, we have a machinery. We have a machinery. For how much did we acquire it? We acquired it for 84 crores. Always remember. See, I'm making little rules for you here and there. Like if you remember, in yesterday's session, I told you, whenever you are doing regular provision, residential status, you always, before basic condition 2, you pause and think. Crew member, Indian ship, you think about leaving India for business or profession outside India, visiting India in the previous year. So you made a rule for yourself over there that if you're finding the residential status and if you're following the regular provision, basic condition 2, you're supposed to pause and check. Then remember one more rule we made for ourselves just now under IFHP. We discuss it whenever we come to interest. We will not stop with only interest. We will always think about two things. We will think about pre-construction interest and current year interest. So little rules like these you make for yourself. One more rule I'm telling you over here. Whenever you add a new asset to the block, you immediately should always think about two things. Number 1, was it put to use for at least 180 days? And number 2, will you have additional depreciation or not? Are you clear with this rule that I'm making for you all? Whenever you add an asset into the block, you will immediately think about two things. Was it put to use for at least 180 days? And number 2, will you get additional depreciation? This one was installed on 1st May 2019. Installed on 1st May 2019, which is definitely going to be at least 180 days, guys. It was put to use for at least 180 days. And will I get additional depreciation on this asset? Yes, I will get additional depreciation. Full 20% I will get additional depreciation. I'll tell you why. See, when do you get additional depreciation? What are the rules and regulations relating to additional depreciation? Let's quickly run through those rules and regulations once. Do I have space? Listen, here let me do it for you. Number 1, assessee has to be a manufacturer or assessee has to be in the business of generation, distribution or transmission of power. Condition number 1. Condition number 2, assessee must be following depreciation in the WDV method, which means if the assessee is following SLM method, then assessee no additional depreciation for you. Condition number 3, which kind of an asset should it be? It should be only plant and machinery. And that too, this plant and machinery should not be second-hand plant and machinery. It should not be a plant and machinery which is used in the office, which is used in the guest house, which is used in the in the rest house. It should not be any of these plant and machineries. Instead, it should be a plant and machinery which is used in the factory. Then it should not be a ship. It should not be an aircraft. For all these assets, you will not get any additional depreciation. It should not be a road transport vehicle. And it should also not be an asset which is already fully deducted. So generally, only plant and machinery you get additional depreciation. But even within plant and machinery, for these plant and machineries, you will not get additional depreciation. Second-hand plant and machineries which are used in the office, guest house, rest house, then ships, aircrafts, road transport vehicles and vehicles wherein you have already claimed full deduction, you have already taken full deduction, for these assets you will not get any additional depreciation. Now here I'm talking about one basic machinery, guys. Is it second-hand machinery? No. Is it used in the office, guest house, rest house? No. Is it a ship? Is it an aircraft? Is it a road transport vehicle? Is it already fully deducted? No. So will I get additional depreciation? Yes, full 20% I'll get additional depreciation. Now look at the next asset that we have over here. We have a lorry for transporting goods to sales depot. We have a lorry. We purchase this lorry for how much? For 3 crores. Again, I told you, you will always check for two things. Was it put to use for at least 180 days? See, it was purchased after 30th November 2019. This is definitely going to be less than 180 days, guys. 30th November. And will I get additional depreciation? Tell me. Will I get additional depreciation? It is a lorry. It is used for transporting goods till the sales depot. It is a road transport vehicle. Will I get additional depreciation? I will not get additional depreciation. It's a road transport vehicle. It is used for transporting goods till the sales depot. Then after this, we have forklift truck. We have forklift truck. Guys, by the way, listen, should lorry, okay, wait, I have one point to discuss with you, okay? Let me finish this question, then I'll discuss. Right now, in between, if we take it, the flow will break. Listen to me. But remember, okay, before I go to the next question, I have to give you one flow chart, okay? Now, forklift truck. Forklift truck is used inside the factory. 4 crores. Now, this 4 crores, tell me, was it put to use for at least 180 days? The question says it was purchased after 30th November. So let us say put to use also after 30th November. Definitely it's going to be less than 180 days. So you'll get only half the year's depreciation. Will you get additional depreciation? This is one of the most important points in this question. Will you get additional depreciation for this forklift truck? Guys, listen. For road transport vehicle, do you get additional depreciation? It's a truck. It's a vehicle. So your first answer will be that, ma'am, it is a truck. It's a road transport vehicle. So don't give additional depreciation. That will be your first answer. But listen, road transport vehicle means what? Road transport vehicle means from point A to point B, from the factory till the sales depot, goods have to be transported. For that, I'm using the vehicle. That is road transportation vehicle. But this forklift is used inside the factory. Inside the factory itself, from here to here. Inside the factory itself, from one corner to another corner, this truck is used. It is used inside the factory itself, which means it is not used for road transportation. It is not used for road transportation. It is not used on the road. It is used within the factory itself. So even though it's a vehicle, it is not a road transportation vehicle. So will I get additional depreciation, please? Yes, I will get additional depreciation. But how much additional depreciation? Less than 180 days. So sorry, only 10% I can give you. Okay, then we have new imported machinery. So we have new imported machinery for how much? For 12 crores. But look at what the question says. The new imported machinery arrived at the Chennai port on 30th March 2020, which means it arrived within the year itself. But guys, it was installed only on 3rd April 2020. Tell me, was it even put to use in the current year? No, it was put to use only on 3rd April 2020. It was put to use. Was it even put to use in the current year? Was it even put to use in the current year? No, in the current year, it was not put to use. Will it still enter the block? Am I right in putting it over here in the block? Yes, it will still enter the block, because is it actual cost of assets put to use? No, it is actual cost of assets acquired. It is actual cost of assets acquired, which means if you buy an asset, even if you have not put it to use, it will still enter the block. You might wonder, ma'am, what are you even saying? You might wonder. Listen to me. Actual cost of assets acquired. If you have purchased an asset, even if you don't put it to use, it will still enter the block, because it is actual cost of assets acquired. Okay, you did not put it to use, so you will not get depreciation. You will get zero depreciation. You did not even put it to use, so you will get zero depreciation, no doubt. But it will still enter the block. See, you did not put it to use in the current year. Don't worry, I will not give you depreciation, but it will still enter the block, because it is not actual cost of assets put to use. It is actual cost of assets acquired. So it is acquired during the year. It will enter the block. Okay, it was not put to use, so don't give me depreciation. That's all. No, but it will still enter the block. Crystal clear with this discussion, everybody? Tell me. It was not even put to use. 0 days. Any additional depreciation? Of course, no additional depreciation because not even put to use. Okay, then after this, less monies payable for assets sold. Have we sold away any asset during the year? Have we sold away any asset during the year? No, we have not sold away any asset during the year. So what is my closing WDV, guys? Closing WDV on 31st March 2020. My closing WDV will be 103 crores. Now pay attention. This 103 crores, I will split into three parts. I will always write 0 days first, no depreciation, 0 days, then less than 180 days, and then balance. We will always fill in the no depreciation part first, then the less than 180 days, and then the balance. Tell me how, for how much out of this 103 crores, which number will come under no depreciation? On which number you will not get depreciation? On this 12 crores, you will get no depreciation at all. On this 12 crores, you will get no depreciation at all, right? What about this less than 180 days? How much is less than 180 days? See, 7 crores is less than 180 days. And what is the balance, guys? 103 minus 12 minus 7, the balance is going to be 84 crores. Okay, now tell me, on this 12 crore, will you get any depreciation? On this 12 crores, you will get no depreciation. 12 crores, you will get no depreciation. On this 7 crore, how much depreciation will you get? When I'm talking about depreciation, I'm talking about normal depreciation right now, not additional depreciation. I'm talking about normal depreciation right now. On the 7 crore, how much depreciation will you get? You will get 7 crores into 15% into 1 by 2. Why 1 by 2? Only half the year's depreciation you will get. Please do not write 7.5% because depreciation rate still remains 15% only. Depreciation rate is 15% only. Only thing, I am giving you half the year's depreciation. So you will write a 7 into 15% into 1 by 2. On this balance 84 crores, you will get full 15% depreciation. So how much is this going to be? It's going to be 0 here. 7 into 15% divided by 2, you will get 0.525 crores here, and on this balance you will get 12.6 crores. So what is your total normal depreciation? Your total normal depreciation is going to be 13.125 crores. This is your total normal depreciation. Now coming to additional depreciation, will you get any additional depreciation? Yes, we've already concluded we're going to get two additional depreciations, right? Here 20% and here 10%. So 84 crores into 20%, that is 16.8 crores. 4 crores into 10%, that is 0.4 crores. So total additional depreciation you're going to get is going to be 17.2 crores. How did I calculate that? On 84 crores, I calculated full 20, no, not 84 crores. Yeah, correct, 84 crores. On 84 crores, I calculated full 20%. I've already done the analysis over here. And on 4 crore, I have calculated 10%. So total additional depreciation is 17.2 crores. So what is going to be the opening WDV for the next year? Opening WDV for the next year, that's going to be 72.675 crores. This is going to be your answer for this question, 72.675. This is the opening WDV for the next year for this SSC. Are we clear with this? Yes. Just a moment. Yeah. So this was our discussion regarding this question. So what is our learning through this question? Our learning is, number one, about additional depreciation. We have revised the whole of the additional depreciation provision. We have revised point number one. And point number two, we made a rule for ourselves that whenever an asset enters a block, we will always think about two things. Number one, we will think about the 180 days point, and number two, we will also think about the additional depreciation point. Always keep this rule in your mind, always. And then we had an important discussion regarding forklift truck. Yes, it is a vehicle, but I'm not using it for road transportation. I'm using it within the factory. So please give me additional depreciation. And then a very important discussion regarding this new imported machinery. Because it was acquired during the year, it will enter the block. Okay, because it was not put to use, don't give me depreciation on that. You will give me depreciation only after I put it to use. But because it was acquired, it will still enter the block. Okay, so this is it about our discussion regarding question number 12. Now I'm taking you to the next question under PGBP, question number 13, which is going to be relating to section 44AE. 44AE. Okay, now let us give it a reading. A very interesting question. It's going to be a combination. This one question will cover everything under 44AE. Yes, guys, wait. Before I proceed, there was one flow chart I had told you I will be giving you all relating to depreciation rate. Okay, listen very carefully. I am talking about lorries, cars, and buses. You know, right? If the vehicle is acquired and put to use in the period 23rd August 2019 to 31st March 2020, you give higher depreciation, right? Regarding that, I wanted to give you one flow chart. See, the reason why I'm giving you over here is, if you look at this question, all the dates were between 1920. If you look at this and all, this period was purchased after 30th November 2019, which means 23rd August 2019 to 31st March 2020. In this period only, these vehicles were purchased, right? But I did not even talk to you about the higher depreciation rate. Why I did not give you higher depreciation rate? I'll give you one flow chart. I'll help you understand. Listen, if it is lorries, cars, buses, these kind of vehicles, you will check, is the first thing that you will check is the assessee in the business of giving these vehicles on hire, or is the assessee not in the business of giving them on hire? If the assessee is in the business of giving them on hire, you will check when was these vehicle acquired and put to use. Was it acquired and put to use in this period 23rd August 2019 to 31st March 2020, or was it put to use into any other period? If it is acquired and put to use in this period, then how much depreciation will you give? 45%. Otherwise, how much depreciation will you give? Normally, you will give 30% because business of giving on hire. Okay. But if assessee is not in the business of giving on hire, this is the whole trick. This is where the entire trick is. Listen carefully. If assessee is not in the business of giving on hire, the first thing that you will check is it a car or is it any other vehicle? Is it a car or is it any other vehicle? If it is a car, you will check, was it acquired and put to use in this period 23rd August 2019 to 31st March 2020? In this period, was it acquired and put to use? If it was acquired and put to use in this period, then what will you do? If it was acquired and put to use in this period, you will give 30% depreciation. Okay. And what if it was acquired and put to use in any other period? In any other period, generally car is 15%. What about other vehicles? Other vehicles like, for example, bus, lorry, truck and all, other vehicles will always remain 15%. Other vehicles will never come under 30%. Are you understanding? See, only if the assessee is in the business of giving on hire, only then for all vehicles, the 30 will become 45. But if assessee is not in the business of giving on hire, only the car 15 will become 30. But for other vehicles, this extra depreciation is not applicable. Is it making sense to you? See, in this question, if you see, was my assessee in the business of giving vehicles on hire? Assessee was not in the business of giving vehicles on hire. So therefore, this is the chart this is a part of the chart which is going to apply to our question in the given question. This is the part that we will apply. Assessee was not in the business of giving on hire. We had vehicles. Was any of the vehicle car? None of the vehicles was car. All the vehicles were lorry, truck only. So that is why we gave only 15%. Even though it was acquired and put to use in this period, we still did not double the depreciation rate. We did not make it 30%. We gave it 15% only. You're understanding? If the assessee is in the business of giving on hire, all the vehicles from 30, it will become 45 in this period. If acquired and put to use in this period, 30 will become 45. Okay. But if the assessee is not in the business of giving on hire, only car 15 will become 30. Other vehicles will continue as it is. Tell me, is this crystal clear for everybody? Yes. Tell me. This is the chart I wanted to give you all. Okay, so only if the assessee is in the business of giving on hire, only then for all the assets, that 30, the 30 will become 45. All the vehicles, for all the vehicles, 30 will become 45. But if assessee is not in the business of giving on hire, then in that case, only car 15 will become 30. Other vehicles was 15, other vehicles will remain 15. Okay, so this was our discussion, that flowchart which I wanted to give you. Now I'm taking you to question number 13. Question number 13 is all about section 44AE. We will give this question one single reading. With this one reading, the question should be clear to us. Look at what the question says. The question says Messrs. MN and Co., a partnership firm, is engaged in the business of plying and hiring goods vehicles. So this assessee is in the business of plying and hiring goods vehicles. It owns the following vehicles on 1st April 2020. So in the beginning of the year itself, it already owns these vehicles. Then, so how many vehicles it already owns? 3, 4, 5, 6, 7, 8, 9. It already owns 9 vehicles. It purchased a vehicle weighing 15,000 kg on 6th June. So now we have how many vehicles? This is the 10th vehicle. We have 10 vehicles which was put to use on 10th July 2020. Net profit of the firm after claiming partners' remuneration of 1,50,000 within the limits prescribed under section 40B from the above business as per books of accounts amounted to 6,50,000. The 6,50,000 is the net profit of the firm as per the books of accounts. The firm has declared income for the assessment year 21-22 in accordance with the provisions of presumptive income under 44AE. First question they're asking us, compute income of the firm if it opts for provisions of 44AE. So if this firm is opting for section 44AE, then what is the income of the firm? Basically, what's the PGBP of this firm if this firm is opting for 44AE? Now listen, if you want to choose 44AE, if you want to apply presumptive taxation under 44AE, first of all, you have to fulfill some conditions. Assessee has to be in the business of plying, hiring, leasing goods carriages, and assessee should not have more than 10 goods carriages. At any point of time during the year, he can have max to max 10 goods carriages. It can't be more than 10 goods carriages, right guys? And assessee can be any person, even company, even company, even firm, even LLP. Assessee can be any person. It is not necessary only individual. Assessee can even be a partnership firm. Assessee is a partnership firm, that is okay. Even partnership firm is allowed. Assessee has to be in the business of plying, hiring, leasing goods carriages. Assessee should not be having more than 10 goods carriages. These conditions are fulfilled over here because assessee has totally how many vehicles? Initially, we have only 9 vehicles. Then we have one more vehicle which we purchased during the year. So no, we don't have more than 10 vehicles, and assessee is in the business of plying, hiring, leasing goods carriages only. All our conditions are fulfilled. So therefore, yes, we can follow 44AE. Now, how are we going to compute 44AE? Let us talk about these 9 vehicles first of all. Tell me 7,000, it can carry 7,000 kgs. Heavy vehicle or other vehicle? Heavy vehicle or other vehicle, 7,000 kgs. This is going to be other vehicle. 9,000 kgs. 9,000 kgs. This is also going to be other vehicle. What about 12,000 kgs? It can carry 12,000 kgs. 12,000 kg, will it be heavy vehicle or will it be other vehicle? See, first of all, tell me, is it heavy vehicle and light vehicle, or is it heavy vehicle and other vehicle? First of all, answer that. It is heavy vehicle and other vehicle. Okay, now for other vehicle, how do you calculate? Tell me. For other vehicle, you calculate it as 1,000 rupees per ton per month, right? Per 1,000 rupees per ton per month per vehicle. That's how you calculate for other vehicles. And how do you calculate for heavy vehicles? Heavy vehicles, it's 7,500 per ton per vehicle, right guys? So basically, see, wait, let me put it down for you, otherwise I think that will be better. 1 minute. Here, I'll do it over here. See, if it is a heavy vehicle, how will you calculate PGBP? Heavy vehicle will be 7,500 rupees per month. That's it, per month per vehicle, right? And if it is going to be, no, what am I doing? This is for other vehicle. If it is other vehicle, it is going to be 7,500 per month per vehicle. If it is heavy vehicle, then what do you do? 1,000 rupees. 1,000 rupees per month per vehicle. And one more thing, per month, per vehicle, and per ton. Per ton, right? And here when we say month, even a part of the month is counted as full month. Even a part of the month, we consider it as if it is full month. Now, what do you mean by heavy vehicle? Heavy vehicle means it can carry more than 12,000 kg. It is not at least 12,000 kg. It is more than 12,000 kg. Are you understanding? It has to be more than 12,000 kg. It can't be up to 12,000 kg. In this question, if you see, it is exactly 12,000 kg. So is this heavy vehicle or is this other vehicle? It's going to be other vehicle. Only if it can carry more than 12,000 kg, only then I will call it as heavy vehicle. This can carry exactly 12,000 kg. So this is going to be only an other vehicle. 15,000 kg is going to be what? Obviously, heavy vehicle. Okay, let us handle these 9 vehicles first. So talking about the other vehicles, totally how many other vehicles we have? In the beginning of the year itself, totally we have 7 other vehicles. So if we talk about other vehicles, we have 7 vehicles. How will you calculate? 7,500 rupees per month, right? 7,500 rupees per month. How many months? All 12 months, because we have these 7 vehicles we're having from the beginning of the year itself. So 7 vehicles, 7,500 rupees per vehicle per month. So into 12 months, this is going to be how much? 6,30,000 rupees. Then after this, these are our other vehicles, first 3 done. Now heavy vehicle, we have only one heavy vehicle. Heavy vehicle means it can carry more than 12,000 kg, not at least, it is more than, which means even equal to 12,000 kg will be other vehicle. Only if it is more than 12,000 kg, you'll put it under heavy vehicle. So heavy vehicle, how many do you have? You have 2 vehicles. For heavy vehicles, how do you calculate? Heavy vehicles, it's 1,000 rupees per vehicle per month and also per ton. So this is 15,000 kg. 15,000 kg means how many tons? 15,000 kg means 15 tons. This is going to work out to how much? 2 into 1,000 into 12 into 15. This is going to be 3,60,000 rupees. In addition to this, we have purchased one more vehicle. This vehicle is weighing 15,000 kg. Is it heavy vehicle or other vehicle? Even this is going to be a heavy vehicle, guys, because 15,000 kg more than 12,000 kg. So how will you calculate this? It is one vehicle into 1,000 rupees per month. How many months? It was purchased on 6th June and it was put to use on 10th July. Tell me, out of these 2 dates, which date is relevant for me first of all? 6th June or 10th July? Out of these 2 dates, first of all, which date is relevant for us? 6th June or 10th July? 6th June. Even yesterday, I remember I told you even in the last session that when was it put to use, that's going to be irrelevant. Put to use is a concept which we keep only in depreciation. Put to use is a concept which we think about, which we talk about only in depreciation. We don't talk about put to use in anywhere else in scientific research, in 35 AD, in 44 AE, nowhere else we talk about put to use. Put to use we talk about only in depreciation. Here we are talking about 44 AE. So when was it put to use? It is irrelevant. Okay, so which means what is relevant for me is 6th June 2020. So 6th June 2020, June onwards, June, July, August, September, October, November, December, Jan, Feb, March, it's going to be 10 months. Will it bother you that June only after 6th? Will it bother you? No. Even a part of the month you will count as if it is whole month. So even though June, only part of June, you will count June fully. That's going to be how many months? That's going to be 10 months. So per vehicle, 1,000 rupees per month for 10 months into how many tons? It can carry 15,000 kgs, guys. 15,000 kgs means 15 tons. This is going to be how much? 1,000 into 10 into 15. This is going to be 1,50,000. So as of now, what's the total income under 44A? As of now, it is going to be 11,40,000 rupees, guys. Now tell me, listen carefully. What are all your presumptive taxation sections? What are all your presumptive taxation sections? Tell me. You have totally 3 presumptive taxation sections, right? What are the 3 presumptive taxation sections? 44AD, 44AE, 44ADA, and 44AE. Now tell me, in 44AD, how do you calculate your PGBP in 44AD? What are the numbers? What are the numbers? Sometimes 6% of your turnover, sometimes 8% of the turnover. 6% of the turnover if the turnover has been realized in specified mode on or before 139.1 due date, then 6% of turnover, otherwise 8% of turnover. That's all. This is a PGBP. No allowance, no disallowance. This is a PGBP number. 44 ADA, what do you do? In 44 ADA, 50% of your gross receipts, that is going to be PGBP. That's all. No allowance, no disallowance. 44 AE, what will be your PGBP? In case you have other vehicles, it's going to be rupees 7,500 per month per vehicle. And if it's going to be heavy vehicle means it can carry more than 12,000 kg. More than 12,000 kg, it's going to be rupees 1,000 per month per vehicle. But one more thing, also per ton. This is what we've learned. Now listen, whatever you calculate like this, after this, there is one allowance which I will give you. What is that one allowance which I will give you? Number one, partner's salary under section 40B, and also partner's interest. Partner's interest, partner salary, that allowance I will still give you. In 44AD, I will not give you. Only in 44AE, I will give you one allowance, which is partner's salary and partner's interest. I will give you only this final answer, only this will be PGBP. This is the thing that I wanted to discuss with you through this question. That is the whole reason why I have chosen this question. In this question, RSSE is a partnership firm, and this partnership firm has partner salary of 1,50,000, which is within the limit. So can I subtract this 1,50,000 over here? Yes, I can subtract this 1,50,000 over here. Two allowances I am allowed in 44AE. One is partner salary and the other is partner's interest. In 44AD and ADA, it is not allowed. It is allowed only in 44AE. Has this point registered in each of your minds? Yes, guys, partner salary, partner's interest, these are the only two allowances which are allowed only in 44AE, not in 44AD, not in 44ADA, only in 44AE it is allowed. So that is why I'm subtracting partner's salary, I'm subtracting partner's interest over here. We don't have any interest, we only have salary over here. So what is our net number? Our net number is going to be 9,90,000. This is going to be the PGBP of this assessee. This 9,90,000 will become the PGBP under section 44AE of this assessee. Okay, guys, now tell me, if this assessee is going to follow presumptive taxation under 44AE, if this assessee follows presumptive taxation under 44AE, does this assessee have to maintain books of accounts? No need. Does this assessee have to get the books of accounts audited? No need. Advance tax, how many installments this assessee has to pay? Advance tax, all installments you have to pay. Had it been 44AD or 44AD, I would have said you have to pay only one installment. That is only the last installment I would have told you. But this is 44AE. In 44AE, you have to pay all the installments. Okay, keep this in mind and look at the next question. If the firm wants to claim its income as per books of accounts, then what will be the consequences? If the firm wants to claim as per books of accounts means what? As per books of accounts means assessee does not want to follow 44AE. Assessee does not want to follow 44AE. Assessee wants to follow normal taxation. Then what will be the consequences? The consequences will be, listen, assessee, in that case, if 44AE is applicable to you, but still if you don't apply 44AE, number one, you will have to maintain books of accounts. Number two, you will have to get those books of accounts audited. Two consequences you will have. You will have to, number one, maintain books of accounts, and number two, you'll have to get the books of accounts audited. Okay, now they're asking us what is a due date? What is a due date for filing the income tax return? See, if the assessee follows 44AE presumptive taxation, then tell me, in that case, will audit apply for the assessee? If he is following 44AE, will audit apply for the assessee? Audit will not apply. If audit will not apply, what will be the 139.1 due date for this assessee? 31st July will be the 139.1 due date, 31st July of the assessment year. But if 44AE is applicable for the assessee, but still assessee is not following 44AE, then he'll have to maintain books of accounts. He will also have to get them audited, guys. If he has to get them audited, then what will be the 139.1 due date? There, the 139.1 due date will become 31st October of the assessment year. Story over. Perfect clarity. This was our second question from PGBP. Yes, guys. So with this, we're done with the 13th question. This question was helping you to understand 44AE, which is your presumptive taxation relating to assessees who are in the business of plying, hiring, leasing goods carriages. They should not have more than 10 goods carriages. In 44AD and in 44ADA, I will not let you subtract partner salary and partner's interest. But in 44AE alone, I will let you subtract partner salary, partner's interest. Okay, let's go to the next question now. Come on, you guys. Let us go to question number 14. Okay, question number 14 is your typical PGBP question, which is your P&L account followed by a list of adjustments. But even over here, purposely I have brought in this question. There is one adjustment over here which is going to be an eye-opener for you all. Okay, look at this question. Let us have a quick glance at the question and then we'll work it out. Mr. Chauhan is having a trading business and his trading and P&L account for financial year 17-18 is given to us. So previous year 17-18, assessment year 18-19, they have given us a trading and P&L account. They have given us information. They're asking us to find the business income. They're asking us to find just the PGBP of this assessee for assessment year 18-19. So we have to compute just the PGBP for previous year 17-18, that is for assessment year 18-19. Guys, we have to compute PGBP and we do have the net profit number. Therefore, how are we going to compute PGBP? We will use the 5 steps. What if the net profit number was not given to us? If net profit number was not given to us, in that case, you will just take the taxable business incomes, you will subtract the allowable expenses, and you will get the PGBP. This is the step that you follow. This is the process that you follow if you don't have the net profit number. But if you do have the net profit number, then you follow your 5 steps. If you don't have the net profit number, then taxable income minus allowable expenses will give you PGBP. But if you do have the net profit number, then you follow 5 steps. Here I do have the net profit number, so I will follow my 5 steps. How will my 5 steps start? What is my first step? Net profit as per P&L account. My first step will be net profit as per P&L account. Then what will I add? I'll add all those expenses which are debited to my P&L account but not allowed. Debited but not allowed. Then we'll add all those incomes which are not credited to our P&L account but taxable. Then we'll subtract all those expenses which are not debited but allowed. And finally, we'll subtract all those incomes which are credited but not taxable. So this is going to be your 5 steps. We will start with net profit as per P&L account. We'll add expenses debited but not allowed. We'll add incomes not credited but taxable. We'll subtract expenses which are not debited but allowed, and we'll subtract incomes which are credited but not taxable. Look at the P&L account now. Sales number. See, look at the sales. Sales is 2 crore 70 lakhs. Sales is more than 2 crore. So therefore, will 44AD apply? 44AD will anyways not apply. No presumptive taxation will apply, because presumptive taxation applies only if turnover is within 2 crores. Here assessee's turnover is more than 2 crores. So no presumptive taxation, normal taxation only I have to do. Sales, closing stock, gross profit, nothing to do. Opening stock, purchase, gross profit, nothing to do. Salary to employees, nothing to do. What about donation to Prime Minister Relief Fund? What about this? Is this a PGBP adjustment? No, it should not be debited, but it is debited. How do I reverse a debit? I'll reverse a debit by adding it back. So donation to Prime Minister National Relief Fund. How much is it? 1 lakh rupees. I will disallow. See, here I'm computing only PGBP, so I will not think about Chapter 6A. But had I computed total income, then this Prime Minister National Relief Fund, where would I have taken to? I would have taken it to Section 80G. And under 80G, how much reduction would I have given? Full 100% reduction I would have given Prime Minister National Relief Fund. Then provision for bad debt. Any provision, any reserve, what do we do? Any provision, any reserve, whatever be the provision, whatever be the reserve, we always disallow. Provisions and reserves, we disallow. Then bonus to employee, interest on bank loan, nothing to do. What about family planning expenditure incurred on employees? Family planning expenditure is allowed only for which assessees? It is allowed only for company assessees. If it is a company assessee, revenue expense on promotion of family planning is going to be fully allowed, and capital expense relating to promotion of family planning, even that will be allowed, but that will be allowed across 5 years. But all of this is only for company, guys. But here, who is my assessee? My assessee is Mr. Chauhan. My assessee is an individual. So will I give him, will I allow this expense for him? I will not allow this expense. It will be allowed only for company assessees. Here, assessee is not a company. Assessee policy is an individual. So therefore, I will disallow. So family planning expenditure, what is the expenditure? 20,000. This I will fully disallow. Had it been a company, then definitely I would have allowed. Depreciation will assume as per Income Tax Act. And then income tax, guys, can we debit income tax? We can't debit income tax because it's a personal tax. So 1 lakh income tax, even this I will disallow. And then we have net profit. Net profit is 11 lakh 50,000. I will write this also in my main answer. Then what else? Looking at the other information, he incurred expenditure on furniture and fixtures 35,000, which is paid in cash on 25th July 2017 to Messrs. Decor World. He incurred expenditure on furniture and fixtures. First of all, tell me furniture and fixtures. First of all, should this be debited to the P&L account? Should this be debited to the P&L account? No, it should not be debited to the P&L account because this is a capital expenditure. It is not a revenue expenditure. So first of all, it should not be debited. Instead, what should you claim? Instead, you should claim depreciation. But here, can I claim depreciation also? In this question, I can't claim depreciation also. Why I can't claim depreciation, guys? Because more than 10,000 I have paid in cash, which is a non-specified mode. Cash is not a specified mode. If you are paying more than 10,000 in one day for one asset to one supplier against one invoice, more than 10,000, how should we pay? We should pay only by account pay, check account pay, bank draft, ECS, or any other electronic mode. Here we have paid it by cash. We have paid it by a non-specified mode. So because we have paid it by non-specified mode, it will not even enter the block. I will not give any depreciation on this asset. It will not enter the block, so no depreciation also. So neither will it be debited to the P&L, nor will it get depreciation, nor will it get any depreciation. Then depreciation allowable 40,000, excluding depreciation on furniture and fixtures. Good. You are anyways not supposed to give depreciation on furniture and fixtures. Good that it is already excluding the depreciation on furniture and fixtures, which means that this depreciation given to us over here is not as per Income Tax Act. So I'll disallow that depreciation. Depreciation which is there in the P&L account 30,000, I'll disallow that depreciation. Instead, I will allow depreciation under section 32 of Income Tax Act, which is 40,000. And this depreciation does not include furniture and fixtures depreciation. Good only. Anyways, it should not include because furniture and fixtures is anyways not depreciable in this question because more than 10,000 we have paid using non-specified mode. Then comes the next adjustment, the star adjustment of this question. No deduction of tax at source on payment of interest on bank loan has been made. They are saying that we did not deduct tax at source on payment of interest on bank loan. Guys, we did not deduct tax at source. Which section comes to your mind? Section 40A1 and section 40A1A should come to your mind. I hope you recall even yesterday in one of the total income questions we had seen this. Now here, does the question say that we are making the payment of interest outside India, or does the question say we are making the payment to a non-resident? No. So therefore, it is not 40A1, it has to be 40A1A. Under 40A1A, how much do we disallow? 30% we disallow. But do you remember, I had told you yesterday that whenever you have this adjustment, do you blindly disallow? Just because TDS was not deducted, will you blindly disallow? No. Remember, even in that question yesterday, we had analyzed that which TDS section will apply. Was TDS first of all deductible? If TDS was deductible and then you did not deduct tax, only then it is a problem. But if TDS is not deductible, and if you did not deduct, will you still disallow? Of course not. So that is one thing which you should think always. So here 40A1A 30%, but don't straight away disallow. First think, is TDS even applicable? Guys, payment of interest on bank loan. So first of all, which section will you think about? You will think about section 194A. It is section 194A which talks about TDS on interest. Everybody agrees it is 194A which talks about TDS on interest. But under 194A, tell me, interest on bank loan, do we have to deduct tax? When I pay interest to the bank, will I deduct tax? No. No, when we pay, listen, when the bank pays us interest, the bank will deduct tax. But when we pay tax to the bank, when we pay tax to the income tax department, or when income tax department pays what am I saying? When I pay interest to the bank, or when I pay interest to the income tax department, or if income tax department pays interest to me, or if I pay interest to the central government, if I pay interest to the RBI, if the partnership firm pays interest to the partners, in all these cases, do we deduct tax under 194A? We don't. So in 194A, there's one big list of exclusions, right? One of those points in that list of exclusions is When we pay interest to the bank, we don't deduct tax. When bank pays us interest, the bank will deduct tax. But when we pay interest to the bank, we do not deduct any tax. So here we are paying interest on bank loan. Assessee is paying interest on bank loan. Is tax even deductible under 194A? It is anyways not deductible. It is anyways not deductible. So assessee did not deduct. Did assessee do a violation by not deducting? Assessee did not violate by not deducting because tax is anyways not deductible. So will there be any 40A1 disallowance? No. This is a star adjustment of this question. It is for this adjustment that I worked out this question for you. Now look at the next adjustment. Out of salary, 25,000 pertains to his contribution to RPF, which was deposited after the due date of filing return of income. What about this? Which section? Employers, assessees contribution, employers contribution to RPF. In PGBP, which section will apply? Section 43B will apply. 43B says employer's contribution to RPF and all. You should actually make the payment within 139(1) due date. The question says payment was made after the due date. So therefore, we'll disallow, guys. We'll disallow employer's contribution to RPF. We will disallow under section 43B. We will disallow. How much we will disallow? This 25,000 we will fully disallow. Now listen to the next adjustment, the last adjustment. Further, employees' contribution of 25,000 was also deposited after the due date of filing return of income. Employees' contribution was also deposited after filing the due date of return of income. What about this? For employees' contribution, what are you supposed to do? For employees' contribution, does 43B apply there also? No. See, listen, for employees' contribution, we have two other sections. Under section 22410, we first tax it as income. Whatever is the employee's contribution which the employer has received, first we will tax it as income. Then whatever payment is made within which due date? Whatever payment is made within PF due date. Whatever payment you have made within PF due date under 3615A, it is going to be allowed. So first, whatever is the employee's contribution, whatever is the employee's contribution received by the employer, first I will tax it. I will assume it to be income. First, I will tax it. Assuming it is income, I will first tax it. The whole of the employee's contribution, I will first tax it. Then out of the employee's contribution, how much have we actually remitted within PF due date? Not 139(1) due date, instead PF due date. How much of the employee's contribution have we remitted within PF due date? That much alone we will allow under 3615A. Is this clear? Yes. Now here the question says employee's contribution is 25,000. First of all, without even thinking about anything else, first employee's contribution, I will tax it. So add income not credited but taxable. Employee's contribution, without even thinking about anything else, I will first tax it. It has to be first taxed under 22410. It has to be taxed. Under section 22410, it has to be first taxed. Full amount has to be taxed. Now check. Did we remit within PF due date? It was deposited after due date of filing return of income. They are saying it was deposited after 139(1) due date. They are not saying whether it was deposited within PF due date or not. They are talking about 139(1) due date. But guys, if they are depositing after 139(1) due date, definitely they have deposited after PF due date also, because 139(1) due date at least is till July, till October, till November. But PF due date is generally next month itself. So if you are depositing after 139(1) due date, definitely you have deposited after PF due date also. So therefore, will I allow it under 3615A? Under 3615A, I will not allow. Now everybody has understood this? Yes. So whatever, did you notice, without even reading this adjustment, as soon as I saw that the employees have contributed, I first taxed it as income. Whatever is the employee's contribution to RPF, I will first fully tax it as income. If it is paid within PF due date, then I will allow it under 3615A. So there will always be two adjustments for employees' contribution received by the employer. You will first tax it as income, and if paid within 139, if paid within PF due date, then you will allow it under 3615A. Crystal clear with this whole thing? Yes, guys. Now come on, add, subtract, find the total PGBP number. Do you get 14,60,000? Yes. Can we proceed, guys? Can we close this question? What was our learning through this question? Our first and the most important learning through this question was about the tedious point. Just because the question says the tax was not deducted at source, we will not blindly disallow. We have to first of all check that is tax even deductible. Only then we will disallow under 40A1, 40A1A. Our second important learning through the question was about employees' contribution. I will not say that employers' contribution is a learning. Employers' contribution 43B, that everybody knows. Our bigger learning over here was regarding employees' contribution. Whatever is the employee's contribution towards RPF, whatever is the employee's contribution which the employee has given to the employer, it will first be taxed as income of the employer under 22410. Then if the employer has actually remitted it within the PF due date, then under 3615A you will allow it. Okay, so with this, we are closing the PGPP important 3 questions. Now I'm taking you to question number 15. Question number 15 and question number 16. I have 2 questions for you over here from the capital gains chapter. This one question over here, the first question from the capital gains chapter, this question will be about your discussion regarding the exemptions. Okay, this first question will be regarding exemptions, and the second question that you are going to be having relating to the capital gains, that will be from slump sale. Okay, so 2 questions you're going to work out under capital gains. Let us pick question number 15. Question number 15 is going to be from capital gains regarding the exemptions. Let us give it a reading. And do you remember what I had told you in the last session? Whenever it comes to capital gains, how do you do the question? I had given you a sort of a technique. I had given you a sequence. Do you recall that? Yes, I had told you that you are first supposed to read the question and then you just start solving. What is the first step with which you will start? You will start with capital asset, then period of holding, and then you will do the computation, and then you will write which year it's going to be taxed in, right? So that same method we're going to follow even over here. All right, one quick reading first. Mr. Suresh has a sole proprietary manufacturing unit. He's a manufacturer. So in our entire syllabus, if assessee is a manufacturer, the only special provision for this assessee is additional depreciation. So he's a sole proprietor. He has a manufacturing unit. On 1st April 2022, he owns plant A and plant B. Originally, he had plant A and plant B. 15% depreciation. Okay. Depreciated value of the book on depreciated value of the block on 1st April 2022 is 10 lakh. What is this 10 lakh? This is going to be the opening WDV. Plant B is transferred on 15th October. So we had plant A, we had plant B. Plant B is sold on 15th October for 19 lakhs. Expenditure on transfer of plant B is 20,000. Then plant C is purchased on 10th March. So we purchased plant C. For 22 lakhs, we purchased plant C. However, plant C is put to use only on 2nd September 2023. Business income of Mr. Suresh before claiming depreciation is 11 lakhs. On 1st March 2023, Mr. Suresh transfers 900 equity shares in A Limited for 23,50,000. Mr. Suresh does not own any residential house property. These shares were purchased on 2nd April 2015 for 2 lakhs. To avail the benefit of exemption under different sections, he made the following investments. He purchased a residential house property at Kolkata for 19 lakhs, out of which stamp duty expenditure is 30,000, and he purchased NHI bonds of 3 lakhs. Find out the GTI of Mr. Suresh for assessment year 23-24. This question is covering 3 adjustments. Number 1, it is going to cover your normal usual capital gains calculation. Number 2, it will cover exemption sections. And number 3, it will also cover what if depreciable asset is sold. Depreciable asset sold, this we did not discuss in the PGBP questions. What if the depreciable asset is sold? This we are going to discuss through this question. Okay, now listen to me carefully. If you have a depreciable asset and if you sold away this depreciable asset, what will you do? The first thing that you will check is, has the block become empty? Or is the block has not become empty? If the block has become empty, tell me, is it going to make sense for you to calculate depreciation? No. If the block has become empty, you will either have STCG or you will have STCL, but you will not have any depreciation because block has become empty. But if the block is not empty, you will first try for depreciation. If depreciation is not possible, then you will have STCG. If block is not empty, you will first try for depreciation. If depreciation is not possible, then you will have STCG. This is your basic flowchart. Now look at the question. They are not asking us just to find capital gains. They are asking us to find the GTI of the assessee. They have given us all this information. This first para, if you see, is relating to PGBP. So of course, we do have PGBP in this question. So computation of GTI, PGBP. Let us say for PGBP, I give reference to working note number 1. Okay, and I'll open working note number 1 for PGBP. What is the information that they've given us? They've given us information about the block. So I'll call it as block 1. Block 1, what category of asset? We're talking about the plant and machinery category, 15% depreciation, right? We already had plant A and plant B. Then we sold plant B and then we purchased plant C. We just read the question. What are the steps? We will always start with opening WDV on 1st April. What's the year over here? The year is previous year, 22-23. Assessment year, 23-24, previous year, 22-23. So opening WDV on 1st April 2022. How much is the opening WDV in the beginning of the year, guys? Beginning of the year opening WDV is 10 lakh rupees. Okay. Then what do we do after this? We'll add. What do we add? What's the English? We add actual cost of assets acquired. By now, you know the significance of the word acquired. You know that if an asset is purchased, even if it is not put to use, it will enter the block. Okay, you will give it depreciation only after you start putting it to use. But once it is acquired, it will enter the block whether put to use or not. Now, how many assets have we acquired over here? We have acquired only one asset over here. We have acquired plant C. We have acquired plant C for how much? Plant C is purchased for 22 lakh rupees. Now, I told you, I gave you a rule. Whenever you purchase an asset, you always think about two things. Number one, was it put to use for at least 180 days? The question says, plant C was put to use only on 2nd September 2023. Tell me, was it put to use in the current year? It was not even put to use in the current year. So 0 days. Forget about 180 days. It was not put into use at all. It was not even put into use during the year. If it is not even put to use during the year, will you have additional depreciation? Not at all. Then after this, what do you subtract? You subtract monies payable for assets sold. Guys, you know, right? By plant C, even though it is not put to use, why did I still put it into the block? You grasped that point. Even in the last question, I have discussed it with you. Yes, it is not put to use at all, but it is acquired during the year. Therefore, it will enter the block. You will not get depreciation on this number, but it will still enter the block. Then less money is payable for assets sold. Have we sold an asset during the year? Yes, we have sold plant B. For how much have we sold plant B? The question says plant B is sold away for 19 lakh. And they're saying expenditure on transfer of plant B is 20,000. So tell me, how much will you consider as monies payable? 19 lakh is a sale price. Expenditure on transfer is 20,000. So will you say 19 lakhs or will you say 18 lakh 80,000? What is the monies payable? See, this is monies payable, only sale consideration. Here I don't consider expenses on transfer and all. What is the monies payable? What is the sale consideration? The sale consideration is 19 lakhs. This 19 lakhs, I'll take it as it is as a monies payable. Now listen, we have sold away an asset. Because we sold away an asset, this flowchart will come to our mind. Tell me, because of selling plant B, has the block become empty? No, the block is not empty. We still have plant A, we still have plant C. Block has not become empty. So first, what will I try for? Because the block has not become empty, I will first try for depreciation. Only if depreciation is not possible, only then I will come to STCG. Clear, everybody? Yes. Now coming to the question. Tell me, what is a closing WDV on 31st March 2023? The closing WDV on 22 March 2023 is going to be 13 lakhs. Guys, listen, we sold plant B. The block was not empty. We are going to first try for depreciation. Is depreciation possible? Yes, it is possible. I have a positive WDV. Depreciation is definitely possible. So therefore, I will definitely try for depreciation. Okay. Now listen, I will split this into how many parts? I'll split this into 3 parts. Number 1, 0 days for which I will get no depreciation. Then less than 180 days. And then balance. This is how I will split it, guys. And do you remember what sequence I told you? Out of these 3, which of 3 do we always fill in first? We always fill no depreciation first, then less than 180 days, and then balance. Tell me, no depreciation is how much value? 22 lakhs. But tell me, can I write 22 lakhs here? Do I have so much WDV? No, I have WDV only 13 lakhs. So therefore, I don't have a choice. I will be able to write only 13 lakh here. So if I've written full 13 lakh here, 0 and 0. So tell me any depreciation in this question. There's going to be no depreciation at all. Understood? A very interesting question. A very recent mock RTP, very recent May 2023 RTP question. Only this was. Did we understand this, everybody? Yes. Did you follow? See, first of all, I let it enter the block. Okay. Even though it was not put to use, I still let it enter the block because actual cost of assets acquired. Then we sold away an asset. Because we sold away an asset, my block did not become empty. So I will first try for depreciation. So I subtracted the monies payable. The WDV number was positive, which means depreciation is possible. So I'm trying for depreciation. But when I'm trying for depreciation, I'm getting stuck. Why am I getting stuck? Why am I getting stuck? Because the zero depreciation, I'm supposed to fill in that first. That is 22 lakhs. And my WDV is only 13 lakhs. So I can't write 22 lakhs here. When my WDV itself is 13 lakhs, I can't write 22 lakhs here. So I will be able to restrict it to 13 lakhs only. So I've written the full 13 lakhs here. So nothing is left over here. This is no depreciation bucket. So zero depreciation. Here no WDV, so zero depreciation. Here also no WDV, so zero depreciation. So depreciation in this question is 0. So what will the PGBP of my assessee be? Business income of Mr. Suresh before claiming depreciation is 11 lakh. So even after depreciation, it's going to be how much? PGBP is going to be 11 lakh only because there is no depreciation in this question. So PGBP of this assessee is going to be 11 lakhs. Assessee, sorry, you're not going to get any depreciation at all. Can I close this working note? Can I take you to the next working note now? Your next working note is going to be regarding the sale of shares. Yes, come on, let us look at this adjustment now. On 1st March 2023, Mr. Suresh transferred 900 equity shares in A Limited unlisted shares. So guys, as usual, tell me what's our first step. First of all, we have capital gains. Let us say working note number 2. I'll open working note number 2 for capital gains. The usual steps we'll follow. How will we start? No need to think too much. No need to visualize the answer. No need to imagine how the answer is going to be. Straight away start writing. Your hand should just flow. What is a capital asset in this question? The capital asset are shares. Give me more clarity. They are equity shares. Give me some more clarity. They are unlisted equity shares. Give me even more clarity. They are totally 900 unlisted equity shares. Then after capital asset, what's the next step you do? The period of holding. When did we buy these shares? The question says these shares were purchased on 2nd April 2015. So 2nd April 2015. And when did we sell away these shares? On 1st March 2023. Now this period is definitely more than 12, 24, 36. Unlisted equity shares, guys, it's going to be 24 months. It is more than 24 months. Therefore, what kind of an asset? Long-term capital asset. Therefore, which section? Section 112. Not 112A, guys, 112. 112A you can apply only if they are listed shares, right? Here they are unlisted shares, so not 112A, we will apply 112. In the yesterday's session, we have already seen 111A and 112A. Only 112 was pending. 112 we have brought in through this question. So if you're noticing, guys, through these questions, many of your adjustments are getting covered. Like, purposely those questions have been chosen so that through these questions, as much revision as possible is happening. My objective to bring in these 30 questions. See, listen, we did 30 questions in law also, right? Those 30 questions which I've chosen in law are those questions which copy paste you might find in the examination. I'm not saying you will. Copy paste, you might find some questions in the examination. They're the most important questions from the examination point of view. But if you look at income tax, I am not saying any of these questions copy paste will come in your examination. But I am saying that many of these adjustments you will find in your examination. Most of the adjustments which you will find in your examination, many of them will get covered through these 30 questions, because each of these questions are covering different adjustments. We are not repeating the adjustments. Okay, so make sure that you tell your friends who haven't watched the session to at least watch it on YouTube and finish it before the examination. Are you understanding? Tell them to make sure that you have to work out these 30 questions, because most of the adjustments will get covered through these 30 questions purely from the examination point of view. Okay, so coming back, so period of holding, we've concluded it is long-term capital asset. It is 112. We have concluded. Now, after this, we will start off with the computation. Tell me, how do we start the computation? What's our first step? Our first step is full value consideration. We sold these shares for how much? He transferred these 900 shares for 23,50,000. After this, we subtract expenses on transfer. Does the question talk about expenses on transfer? No, we had expenses on transfer only relating to the depreciable asset. For this unlisted shares, we don't have any expenses on transfer. So this 23,50,000 as it is, it becomes a net consideration. Then after this, what do we subtract? Tell me. After this, we subtract index cost of acquisition. I can index it, guys. It is long term. It is not 112 week. It is not slump sale. It is not debentures. It is not bonds. It is not depreciable asset. So I can index the cost of acquisition. What is the cost of acquisition? The cost of acquisition is 2 lakh rupees. So 2 lakh rupees into CII of the year of transfer. See here itself. What is the year of transfer? The year of transfer is 22-23. 22-23, the indexation is 331 divided by the CII of the year of purchase. Year of purchase is 15-16. 15-16, what is the index? 254. So if you do your math over here, how much does it work out to? 2 lakh into 331 divided by 254. This is going to be 26. No, 2,60,000. 630. This is your index cost of acquisition. And then do we have any index cost of improvement? No, of course not. They are shares. So 2,60,630 and 23,50,000. So what's your LTCG as of now? You have 20,89,370. This is your LTCG number as of now. Now listen, we are going to talk about the exemptions. Assessee has sold unlisted shares and he has bought a house. He has bought a house. You will think about two exemption sections, Section 54 and Section 54F. But we can talk about Section 54 only if assessee has sold a house and purchased a house. Assessee did not sell a house here, so we can't talk about 54. When does 54F apply? 54F applies if assessee has sold any long-term capital asset which is not a house, and assessee should have bought a residential house. Yes, that is exactly what happened. He has sold an asset, he has sold shares which are long-term capital asset and which is not a house, and he has bought one residential house property in India. So yes, I will think about Section 54F. But tell me, under Section 54F, do I straight away take the number and give it as an exemption? No. We have a formula over here. What is the formula? Amount invested into LTCG by net consideration. This is the formula that we have to follow. What is the amount invested? How much have we invested in the new house? We have invested 19 lakh in the new house, out of which stamp duty is 30,000. Anything to be done? We can take 19 lakh as it is. Amount invested in the new house is 19 lakh. It includes stamp duty. It's okay. Take including stamp duty. So amount invested in the new house is 19 lakhs into, what is the LTCG number? The LTCG number is 20 lakh 89,370 divided by net consideration. What's the net consideration number? 23 lakh 50,000. So tell me, what is going to be our 54F exemption? 54F exemption is going to be 16,89,278. Right? Because we have considered stamp duty here itself. See, you know, right, in chapter 6A, ATC, whatever stamp duty you have paid, even that you get a deduction under ATC, right? If you're claiming ATC in over here itself, in 54F itself, if you're considering stamp duty, can you take stamp duty again under ATC? You can't take again over there. Okay, so you can't take in two places. I've already considered stamp duty in 54F exemption. I'm already considering stamp duty. This 19 lakh includes stamp duty, and I'm not bothering. I'm still taking 19 lakhs. So in that case, that same stamp duty again you cannot take as a deduction under ATC. That's all. So this is our 54F exemption. We applied the formula. Now tell me, this new house that you have purchased in Kolkata, you have a lock-in period of how many years? Lock-in period of 3 years. Now in these 3 years, what you should not do? You should not sell away the house in these 3 years. What if you sell away the house? Then whatever LTCG was exempt earlier, that LTCG will be taxed for you in the year of violation. Now tell me, you purchased the new house. You should have purchased the new house within how many years from the date of transfer? You should have purchased the house within 2 years, either 1 year before transfer or 2 years after transfer. And if you're constructing, you must complete the construction within 3 years from transfer. Here, yes, 1st March the transfer happened. 1st May it was purchased. So yes, it was purchased within the time limit. And if you notice, it was also purchased within 139(1) due date. Why am I talking about 139(1) due date? Because if you're purchasing after 139(1) 139.1 due date, we'll have to put the money into CGD account, capital gains deposit account. Here, thankfully, the purchase was made before 139.1 due date, so no question of putting money into CGD and all. Then assessee has purchased bonds. As soon as you see bonds, which section comes to your mind? As soon as you see bonds, section 54 EC comes to your mind. But tell me, under 54 EC, what is the asset which you should have sold? Tell me that. Under 54 EC, which asset should have been sold? Which is the only asset that should have been sold? Any immovable property, any land, building, or both you should have sold. Have we sold immovable property? Have we sold any land, building, or both? No, we have sold shares. We have sold shares. So will you get 54 EC exemption? You will not get 54 EC exemption. So what is going to be your taxable LTCG for this assessee? The taxable LTCG is going to be the balance of 4 lakh and 92. This is going to become the taxable LTCG of this assessee. Is this clear for everybody? Yes, no 54 EC. You understood why no 54 EC? You get 54 EC only if the assessee is selling land, building, or both. Here, assessee did not sell land, building, or both. Instead, he has sold unlisted equity shares. So there is no question of getting any 54 EC exemption at all. So what is our LTCG number now? 4 lakhs and 92. This becomes our LTCG number. No other income. So what is the GTI of this assessee? They are not asking us for total income. They are only asking us for GTI. GTI of this assessee is 15 lakh and 92. Do I have to round off this number? No, we round off only the total income number. We don't round off the gross total income number. Perfect. Yes, guys. So with this, we come to an end to question number 15, our first question from the capital gains discussion. Can we go to the next question relating to capital gains? Yes, we have one more question from capital gains, and this one is relating to slump sale. Okay, let us have a look at this question. Let us read this question and then we'll work out. So, question number 15, I hope you got it. The depreciation part also, the unlisted shares section 112 part as well, and also the exemptions part. All right, now look at question number 16, a slump sale question. First of all, let us have a quick revision of the slump sale concept. See, slump sale. One quick revision of the slump sale concept. Point number 1, what is a capital asset over here? The capital asset has to be any unit or any undertaking or any branch. I should be selling the whole unit or the whole undertaking or the branch, the whole thing I should be selling, which means I should be selling this whole thing for a lump sum consideration without allocating consideration individually for each asset separately. I should be selling all the assets for one lump sum consideration. That is when slump sale applies. I should not be allocating individual value for each asset. I must be selling all the assets together for lump sum consideration. That is when this concept of slump sale will apply. Then we had learned what, then tell me, what's the relevant period of holding for slump sale? Is it 12, 24 or 36 months? The relevant period of holding for slump sale cases is 36 months, guys. Yes, then tell me, even if it is a long-term capital asset, you know, right? You will not get any indexation benefit. Even if it is a long-term capital asset, you will not get any indexation benefit. And then tell me one more thing, the cost of acquisition and cost of improvement put together in slump sale cases should be what? The cost of acquisition and cost of improvement put together is going to be the net worth of that undertaking. Net worth of that undertaking means what? Net worth means assets minus liabilities. For this net worth, we need one chartered accountant certificate also certifying that yes, the net worth calculation is correct. Now, whenever you're calculating the assets number, in case any asset has been revalued, what will you do with revaluation of assets? Revaluation you will ignore. You're not supposed to consider the revaluation. Then, in case you have any capital asset for which 3580 deduction you have claimed, for that capital asset you will take the value as 0. And then in case you have any self-generated goodwill also value you will take as 0. And last point, what will the full value consideration be in slump sale cases? In full value, the full value consideration will be, you will see two things, FMV of the unit and you will see FMV of the consideration. FMV of the unit and FMV of the consideration. You will compare both. And out of these two numbers, you will pick whichever is a higher number. That's going to be your full value consideration. Understanding, everybody? So slum sale, these are the provisions which you should be aware of. Here I am selling the whole unit, I am selling the whole undertaking, I am selling the whole branch itself for a lump sum consideration without even allocating an individual value for each asset. I am selling it for a lump sum consideration. So the relevant period of holding over here is 36 months. Even if it is a long-term capital asset, you will not get indexation benefit here. Cost of acquisition and cost of improvement put together is nothing but the net worth of this unit. Net worth is nothing but asset minus liability. When you're calculating asset, revaluation you will ignore. If it is 3580 asset, you will take the value as 0. Self-generated goodwill also, you will take the value as 0. And whatever is the net worth, the chartered accountant has to certify that yes, the net worth calculation is correct. What will the full value consideration be? You to find the full value consideration, you will compare two numbers, FMV of the unit which we are transferring and FMV of the consideration, whichever is higher we will take. So this is a discussion regarding the concept. Now let us have a look at the question. Star Enterprises has transferred its unit R to A Limited by way of slum sale on 23rd January 2018. Summarized balance sheet of Star Enterprises on that date is given to us. What are they transferring? They're transferring only unit R they are transferring. Using further information below, compute capital gains arising from the slum sale. Slum sale consideration on transfer of unit R was 920 lakhs. FMB on the date of transfer was 930 lakhs. Fixed asset of unit R includes land which was purchased at 110 lakhs in the year 2008 and was revalued at 140 lakhs. Other fixed assets reflected at 460 lakhs, that is 600 lakhs less the value of land, which represents WDV of those assets as per books. WDV of these assets is 430 lakhs. Unit R was set up by Star Enterprises in October 2006. I'm not going to do any thinking. I'm going to straight away start with my steps. What is my first step? As usual, guys, the same set of steps in every capital gains question. I will start with the capital asset. What is a capital asset in this question? The capital asset in this question is unit R. Then comes period of holding. When did we start this unit R? We started this unit R in October 2006. And when are we selling away this unit R? The question says, Star Enterprises transferred unit R on 23rd January 2018. Now, this period is definitely more than, tell me, 12, 24 or 36. What is the relevant period of holding here? What is a relevant period of holding here? The relevant period of holding is 36 months. It is definitely more than 36 months. Therefore, I can conclude it is a long-term capital asset, right, guys? I can conclude it's a long-term capital asset. Which section will apply? Section 112 will apply because these are not listed equity shares. So I can't apply 112A. 112A is only for listed equity shares, listed units of equity-oriented mutual fund, and listed units of business trust. Now I'll start off with the computation. We will start with full value consideration. What is a full value consideration in this question? They're selling the unit for how much? So the full value consideration is 920 lakhs. And they've given us FMV on the rate of transfer is 930 lakhs. So FMV of the unit or FMV of the consideration, whichever is higher. So which is a higher number here? The higher number here is 930 lakhs. FMV of the unit transferred or FMV of the consideration, whichever is higher. From this, we subtract expenses on transfer. We just read the whole question. We did not have any expense on transfer. So this 930 lakhs as it is becomes our net consideration number. Then from this, we subtract cost of acquisition and cost of improvement put together. Even though it is long term, we can't do indexation. To compute the cost of acquisition and cost of improvement number, we need the net worth number. Net worth will be nothing but the assets minus liabilities. Now, what are the assets of unit R? Just unit R. Unit R, fixed asset of unit R is 600 lakhs. Now, if you look at this 600 lakhs, the question says that this 600 lakhs includes land and it includes other fixed assets. Look at this adjustment. Fixed asset of unit R includes land, which was purchased at 110 lakhs and was revalued at 140 lakhs. So this 600 lakhs includes land. This land original value was 110 lakh, but it was revalued at 140 lakhs. So in the books of accounts, land is how much? Land is 140 lakhs after revaluation. So what is your other fixed assets? Your other fixed asset will be the balance 460 lakh. Now this land 140 lakhs, can you take it as it is? No, you're supposed to ignore the revaluation. You're supposed to consider only the actual value, only 110 lakh you will consider. Now, when you look at the other fixed asset 460 lakhs, they are saying WDV is 430 lakhs. So if whatever other fixed assets you have, you're supposed to take the depreciated number. Depreciated as per the Income Tax Act, you're supposed to consider. So 460 lakhs you will not consider. Instead, you will consider 430 lakhs because this 460 lakh is not as per income tax depreciation. 430 430 lakhs is WDV as per income tax. So therefore, what's the total fixed asset value that you will take now? You will take fixed asset of 110 lakh for land and 430 lakh for other fixed assets. Then what are the other assets that we have? We also have for unit R other assets which are worth 440 lakhs. What are unit R's liabilities? Only one liability we have, which is 140 lakhs. So what is the net worth of unit R? 110 plus 430 plus 440 minus 140, 840 becomes the net worth of this unit. So cost of acquisition plus cost of improvement is going to be this number of 840 lakhs. So therefore, what is the net number now? What is the net number? 90 lakhs. This 90 lakhs, this is going to become the LTCG of this particular assessee. And when will you tax this LTCG? In the year of transfer, that is in previous year 17-18, that is assessment year 18-19. This is the year in which you will end up taxing this number. Getting it? This was a slump sale question. The most important adjustment in slump sale, the adjustment which is going to carry the most number of marks in slump sale is going to be your net worth adjustment. Net worth is nothing but assets minus liabilities. So for whichever asset you are doing revaluation, you will take the number before revaluation. If the asset is a depreciable asset, you will take the depreciated value as per Income Tax Act, WDV as per Income Tax Act. If it is self-generated goodwill, you will take the value as 0. If it is an asset for which you have already claimed 3580 deduction, even there you will take the value as 0. No, Mahalakshmi, it is 17-18 only, 23rd January 2018. So it is previously 17-18, assessment year 18-19 only. All right, so this was question number 16 for you from the capital gains chapter. All right, till here I'm hoping you're having the required clarity. Let's look at question number 17 now. Question number 17 is a pure IFOS question. Let us have a look at the question and then we'll work it out. This question says, Mr. Lalit, a dealer in shares and securities. So remember, he's a dealer in shares and securities. So his stock and trade will be shares and securities. He has entered into the following transactions during the previous year 21-22. So we are talking about previous year 21-22. That is, we're talking about assessment year 22-23. They have given us a list of adjustments over here. What are they asking us? Compute the income of Mr. Lalit chargeable under the head income from other sources and capital gains. They're not asking us total income and all. They're only asking us what is the income from other sources of this assessee and what is the capital gains of this assessee. Income from other sources and capital gains, two things only they're asking us. Let us look at the adjustments. As we see the adjustments, we'll keep making the necessary notes also. He received a motor car of 5 lakhs as a gift from his friend Sunil on the occasion of his marriage anniversary. See, marriage anniversary is not an exempt occasion, but he received a motor car. The motor car is going to be considered as a personal effect, right? Because it is movable and it is going to be used for personal purposes. It is movable and it's going to be used for personal purposes. So therefore, it becomes a personal effect. And if it is a personal effect, I can't call it as movable property. So this will definitely not be taxed. Then he got cash gift of 21,000 from 4 friends. So 21,000 into 4 cash gift. I will see the aggregate cash gift. The aggregate cash gift is 84,000. Aggregate is more than 50,000. Therefore, 84,000 is fully going to be taxed. So under IFOS, we will have cash gift of 84,000. This is going to be fully taxed because it is more than 50,000. Then we have land at Jaipur. Land at Jaipur on 1st July 2021 as a gift from his friend Kabra. The stamp duty value of the land is 6 lakhs on that date. The land was acquired by Mr. Kabra in the previous year 2001-2. See, so he got an immovable property as a gift. Immovable property, each transaction we will check separately, right? Each transaction in immovable property we treat separately. We don't find the aggregate and all for immovable property. The question says that he got this immovable property from his friend Kabra. STV is 6 lakhs. So this is immovable property for no consideration. If you look at the STV is more than 50,000 rupees, right? So therefore, the 6 lakhs is going to be fully taxable. So land which he got from his friend Kabra, how much did he get? It is worth 6 lakh rupees. STV is worth 6 lakh rupees. STV is more than 50,000 rupees. So therefore, STV is taxable. Then after this, the question says that Mr. Lalit purchased from his friend Mr. Abhishek, who is a dealer in shares, 1,000 shares of ABC Limited at 400 rupees each on 19th June 2021, FMV of which was 600 rupees per share. We had just read that our assessee, Mr. Lalit, is a share dealer. So he is buying shares. Now this is going to be a PGBP transaction. This is not an IFOS transaction. This is not a capital gains transaction. So I can simply Ignore this. He is purchasing shares from his friend who is dealer in shares. He is purchasing 1000 shares at 400 rupees per share. But FMV is 600 rupees per share. If you notice over here, something worth 600 rupees he is buying at 400 rupees. So you might start thinking about the inadequate consideration point. But movable asset inadequate consideration, if you want to think about this point, it should first of all be property. But assessee is a share dealer. So for assessee, these shares are going to be stock in trade. Because it is stock in trade, I can't call it as movable property. So therefore, this whole IFOS inadequate consideration concept itself, I will not apply. Instead, this will straight away go to PGBP, and PGBP were anyways not calculating. Then the question says, on 1st November 2021, Mr. Lalit took possession of his residential house property booked by him 2 years back at 20 lakh rupees. STV of the property on 1st November 2021 was 32 lakh rupees and on the date of booking was 24 lakh rupees. He had paid 1 lakh rupees by account pay check as down payment on the date of booking. Let us handle this adjustment. So there is a residential house, there is an immovable property. He has booked it for 20 lakh rupees. And so which means the consideration that he's paying for this house is 20 lakh rupees. But what is the STV of the house? They have given us two STV numbers. STV on 1st November 2021. What is 1st November 2021? The date on which he took possession of the property. And on the date of booking was 24 lakhs. So I can say STV on the date of possession I can say it as registration of the property. STV on the date of registration of the property was 32 lakh rupees and STV on the date of agreement, STV on the date of booking on the date of agreement was 24 lakh rupees. Out of these two STVs, you know very well, we always prefer to take which STV, tell me? We always prefer to take STV on the date of agreement, right? We always prefer to take STV on the date of agreement, but you can take STV on date of agreement only if some consideration buyer has paid to the seller on or before the date of agreement in specified mode. Now, did he pay on or before the date of agreement in specified mode? Yes, he has paid 1 lakh rupees by account pay check, which is a specified mode. So I will take STV on the date of agreement. So something worth 24 lakhs he has purchased by paying just 20 lakhs. So this is nothing but inadequate property. This is nothing but immovable property which he has acquired for inadequate consideration, guys, because something worth 24 lakh rupees he has purchased by paying just 20 lakh rupees. So here I will teach you 6 steps. What is your first step? First step will be the STV. What is the STV? 24 lakhs. You know why I'm taking STV on the date of agreement? Because some consideration buyer has paid to the seller on or before the date of agreement in specified mode. So therefore I'm taking STV on the date of agreement, which is 24 lakhs. Then step 2, what is the full value consideration? What is the amount which he has paid for the property? What is the consideration for the property? He has paid 20 lakhs. So what is the benefit that he has enjoyed? What is the difference? What is the benefit that he has enjoyed? He has enjoyed a benefit of 4 lakh rupees. Okay. Now we will do the next 3 steps. Step 4. Step 4 is a standard. Standard is always 50,000. And then step 5. Step 5 is going to be the it's going to be 5%. 5% of what? No, not 5%. 10%. Sorry. 10% of what? 10% of your actual consideration. What is 10% of consideration? 10% of your consideration is going to be 2 lakh. Now step 6 is going to be step 4 or step 5, whichever is higher. Which is higher here? 2 lakh rupee. 2 lakh rupees is higher. So therefore, now listen, what's the benefit you enjoyed? The benefit you enjoyed is 4 lakh rupees. Now, should this benefit be taxed or not? It all depends upon the step 6 number. If the step 3 number, if the benefit is more than the step 6 number, then yes, the benefit will be taxable. It is more than the step 6 number. Therefore, this 4 lakhs is going to be taxable definitely. This is a very simple method of handling inadequate consideration immovable property. Step 1 STV, step 2 FVC. So you will get the benefit that my assessee has enjoyed. You will get to know what is the benefit that he has enjoyed. Now, is that benefit taxable or not? It depends. It depends upon whether that benefit is more than the step 6 number. If that benefit is more than the step 6 number, only then it is going to be taxed. Only if the benefit is more than the step 6 number, only then it will be taxed. Step 6 number is nothing but standard 50,000 or 10% of the consideration, whichever is higher. So yes, 4 lakh was more than 2 lakhs. So therefore 4 lakh is taxable. 4 lakhs over here is nothing but relating to this residential house property which he acquired for inadequate consideration. Then after this, he received a shop building. He received a building of the fair market value 1,50,000 and cash 50,000 in distribution from ABC Private Limited at the time of liquidation process of the company in proportion of his share capital. The balance in the general reserve of the company attributable to his share capital is 1,25,000. A very interesting adjustment. Read it once again. He received a shop. He received a shop, he received a building of FMV 1,50,000 and cash 50,000 in distribution from ABC Private Limited at the time of liquidation process. So there is liquidation of the company. Assessee was a shareholder of the company. The company is going through liquidation. So upon liquidation, the company has distributed the assets. Company has given shop worth 1,50,000 rupees and cash of 50,000 rupees to this particular assessee. Guys, distribution upon liquidation. The capital gains will apply for whom? Capital gains will apply for the shareholders. Upon liquidation, there is no capital gains implication for the company. It is capital gains implication only for the shareholder. So there will be capital gains head over here. So therefore, now if I have to do the capital gains calculation, the same old steps I will follow. What are the steps? Tell me for capital gains. What's your first step? You will start with capital asset. What is he selling away? What are the assets that he is selling away because of liquidation? Because of liquidation, it is as if the company took away his shares from him, and in return, the company is giving him shop, the company is giving him cash. So what is the asset which he is transferring? The asset which he is transferring is shares. Okay. Have they given us whether it is listed shares, unlisted shares and all? Yes, the company is ABC Private Limited. So therefore, definitely these are going to be unlisted shares. So it is as if he has sold away shares to the company. And what is the period of holding? When did he buy these shares? Have they given us the date of purchase and all? They have not given us the date of purchase. They have not given us the date of liquidation and all. They did not give us anything. So period of holding, we don't know the period of holding. So now coming to the computation part. How will we do the computation? We will start with full value consideration. In liquidation cases, in liquidation cases, what is going to be your full value consideration? In liquidation cases, full value consideration will be whatever is the FMV of the assets that you have received plus whatever cash you have received minus section 222C dividend. This is full value consideration in liquidation cases, guys. Full value consideration in liquidation cases is nothing but FMV of the assets which you have received plus whatever cash you have received minus 222C dividend. Now, what is the FMV of the asset that we have received? We have received this building which is worth 1,50,000 rupees. How much cash have we received? We have received cash of 50,000 rupees. Now, what is a 222C dividend? 222C dividend means what? Whatever distribution the company has made because of liquidation, that distribution to the extent of the accumulated profits of the company, whether capitalized or not, that is going to be considered as 222C dividend. Now, if you notice, the company says that my balance in general reserve is 1,25,000. So 1,25,000 is the total accumulated profits in the company. Now, what is his share in the company? Have they mentioned that? Have they mentioned what is his share in the company? How much share he has in the company? They haven't even given us all that information. They haven't even given us. They are just telling us the distribution. They have only given us little information. They have given us that a company is giving him shop, company is giving him cash. It is ABC Private Limited, and this company is at the time of liquidation process of the company in proportion of his share capital. He has been given 1,50,000 shop, cash 50,000, and balance in the general reserve of the company attributable to his share capital. Attributable to his share capital means what? This 1,25,000 is not total reserve of the company. This 1,25,000 is his share in the reserves of the company. So total how much distribution we have made to him? Total distribution that we have made to him is 2 lakh rupees. How much is his share in the reserves? 1,25,000. So what will be his 222C dividend? 222C dividend is going to be 1,25,000 rupees, guys. What is 222C dividend? Are you understanding? Do I have to go in detail? Are you aware of 222C dividend? 222C, the concept says, if the company is going into liquidation, and because of liquidation, if the company is making a distribution, then whatever distribution the company makes because of liquidation, that distribution up to the accumulated profits will be considered as dividend. So this is the distribution which the company has made. 2 lakh rupees, 1,50,000 shop, 50,000 cash. This is a distribution which the company has made. This distribution will be considered as 222C dividend up to the accumulated profits of the company. What is the accumulated profits? What is his share in the accumulated profits? 1,25,000. So this distribution will be considered as dividend up to accumulated profits. So obviously, what will be the 222C dividend, guys? 1,25,000. This will be the 222C dividend. So what is going to be his full value consideration now? 1,50,000 plus 50,000 minus 1,25,000, 75,000. This is going to be his full value consideration. Okay, now tell me, we have the FPC number. Do we have expenses on transfer? No information given. Have they given us cost of acquisition? No information given. Have they given us cost of improvement? No information is given. Because no information is given, we will simply write that further computation is not possible. They have not even given us information about the cost of acquisition, the cost of the expenses on transfer. Nothing else they have given. They did not even give us a period of holding. No other information they have given. So I'll simply write further computation is not possible. Guys, please remember one small thing under liquidation. In liquidation cases, what is the date of transfer? Tell me. In liquidation cases, date of transfer will be nothing but the date of liquidation. Whenever the liquidation happens, that is going to be considered as a date of transfer. But what is the date of taxation? When do we tax this capital gains? When do we tax the capital gains? We will tax the capital gains only upon distribution. And when we say FMV of assets, we will take on which date? On date of liquidation or on the date of distribution? We will take FMV of the assets also on the date of distribution only. We will consider the date of transfer only. We will consider the date of liquidation only for date of transfer. Otherwise, FMV also will be on the date of distribution only. Even taxation will be upon distribution only. Okay, so this was our entire discussion regarding this liquidation point. So further computation was anyways not possible. Then on 1st March 2022, he sold the plot of land at Jaipur for 8 lakh rupees. He sold the plot of land. Now, which plot of land? Remember, he had received a land from his friend Kabra. He had received a land as a gift from his friend Kabra. That land he's selling away for 8 lakh rupees. He's selling away. So because he's selling away the land, there's going to be capital gains again over here, guys. So for land also, we'll have to do the capital gains computation. Same old steps. First of all, capital asset. What is a capital asset over here? Land. Then comes period of holding. Now listen, when he received the gift from his friend Kabra, there was taxation. We taxed how much? 6 lakh rupees we are taxing, guys. When he received the land, it was taxed for him. That same land, when he sells away later, does any section come to your mind? Section 49 subsection 4, guys. When I received the gift, it was taxable for me under IFOS. Later when I sell it, 49 subsection 4 will apply. Under 49 subsection 4, will I consider previous owner's period of holding? No, I will not consider previous owner's period of holding. When do we consider the previous owner's period of holding? When I received the gift, it was exempt for me. Same thing when I sell away later, I'll apply 49 subsection 1. In 49 subsection 1, I'll consider previous owner's period of holding. But here in this case, when I received the gift, it was taxable for me. When I received the gift, it was taxable for me. So the same gift when I sell away later, 49 subsection 4 will apply. Under 49 subsection 4, I will not consider previous owner's period of holding, previous owner's cost of acquisition, nothing I will consider. I will consider only the assessee's information. So if you see in this question, when will the period of holding start? When did assessee acquire this asset? He acquired this asset on 1st July 2021. You will not even consider the previous owner's information. You will not even consider, because when I received the asset, it was taxable for me. Same thing when I sell away later, I will apply 49 subsection 4, and under 49 subsection 4, under 49 subsection 4, I will not consider the previous owner. So the period of holding will be assessee's period of holding only. It will start on 1st July 2021. And then when did he sell it away? He sold it away on the 1st of March 2022. Now this, if you see, is definitely less than 12/24/36. Land, what's the relevant period of holding? It is 24 months. It does not exceed 24 months. Therefore, what kind of an asset is it? It is going to be definitely a short-term capital asset. Under short-term capital asset, is it a 111A short-term capital asset? No, 111A we apply only for listed equity shares, listed units of business trust, and listed units of equity-oriented mutual fund. Here it is land, so this is going to be normal rate STCG. Now, when I come to the computation, we will start with the full value consideration. For how much did this assessee sell away the land? For how much did this assessee sell away the land? He sold away the land for 8 lakh rupees. From this, we will no expenses on transfer. Straight away will come to cost of acquisition. In 49 subsection 4 cases, what will be the cost of acquisition? Cost of acquisition will be whatever amount assessee had paid to acquire this asset plus whatever was taxable for him under IFOS. Tell me, when assessee got this land, did he pay anything? No, he got it as a gift. So he paid nothing. Plus, what was taxable for him under IFOS? Relating to this land, how much did we tax him under IFOS? 6 lakhs we taxed him under IFOS. So his cost of acquisition is going to be 6 lakhs. No cost of improvement. So 2 lakhs. This is going to be be his short-term capital gain, his normal rate short-term capital gains. Okay, this capital gain will be for which year? When did the transfer happen? The transfer happened in previous year 21-22, that is assessment year 22-23. This is the year in which this STCG is going to be taxed for him. Okay, so this was it about this adjustment regarding the sale of land. Then they've given us just the cost inflation index numbers. So they were asking us about IFOs and they were asking us about capital gains. So total IFOs is how much? Total IFOs we have 18,40,000. Capital gains, if you see, from the sale of land we just calculated how much? From the sale of land we calculated 2 lakhs. From the sale of land we're calculating 2 lakhs STCG, and because of liquidation we are going to say that because of liquidation we will be unable to compute. Why are we unable to compute? Because they haven't given us full information. But we can say for certain that in the liquidation case the full value consideration is going to be 75,000. You understood the full value consideration discussion? In liquidation cases full value consideration will be FMV of the assets which we have received plus cash which we have received minus 222C dividend. Minus 222C dividend. And what will the 222C dividend amount be? Guys, wait, actually we've made a mistake. See, there's one more thing which we should consider. No, what is a 222C dividend? 222C dividend that's going to be taxable under IFOS, right? How much is a 222C dividend that we have concluded? 222C dividend is 1,25,000. So don't you think this also should be taxed for us over here? Under IFOS, 222C dividend will be taxed under IFOS. So therefore, now if you see, what is the total IFOS of the assessee? Total IFOS of the assessee is going to be 12,09,000. This is going to be the IFOS of the assessee. Okay, everything else you must have understood. I think the 222C part alone, let me give you one last revision. 222C says whatever distribution the company is making upon liquidation, that distribution up to the accumulated profits is going to be taxed as 222C dividend. So company made a distribution of 2 lakh rupees. This distribution of 2 lakh rupees up to the accumulated profits, to the extent of accumulated profits, to this extent alone, it will be considered as 222C dividend. Okay, so this is what we have learned through 222C. And also liquidation cases, full value consideration, how to compute. Even this I'm hoping you've understood. Full value consideration will be whatever FMV of assets you have received plus whatever cash you have received minus 222C dividend. This is going to become your full value consideration. Also remember, in liquidation cases, for the company, there will be no tax implications. The tax implications will be only for the shareholder. For the shareholder, we will treat as if he's selling away the shares and in return, he is getting all this from the company. Okay, and through this question, even 49 subsection 4 was a very important discussion for us. When I received the gift, if it is exempt for me, same thing when I sell away later, 49 subsection 1 will apply. In 49 subsection 1, I will consider previous owner also. But when I received the gift, if it was taxable for me, later when I sell the same gift, 49 subsection 4 will apply, in which I don't consider the previous owner at all. Okay, guys. In addition to all of this, we have also covered the adjustment of immovable property for inadequate consideration. In case you have received an immovable property for inadequate consideration, you can follow 6 steps. We will first of all see what is a SDV and what is a consideration. The difference will become the benefit which you have enjoyed. Now, whether this benefit should be taxed or not depends upon the step 6 number. If step 4 is more than step 6, if step 3 is more than step 6, then you will tax the step 3 number. What is step 6? Step 6 is nothing but your 50,000 rupees standard or 10% of consideration, whichever is higher. So if step 3 is more than step 6, only then you will tax step 3. If step 3 is within step 6, then you will not tax step 3. Perfect understanding, everybody? Yes, so this was our entire learning regarding question number 17. Now come to question number 18. Question number 18 is relating to section 222B. We just spoke about 222C. Now we're discussing about 222B. 222C was regarding what? 222C was regarding liquidation, distribution upon liquidation. Now 222B is regarding distribution of deposit certificates, distribution of debenture, or distribution of preference. See, wait, let me explain it to you. When it comes to, wait, let me bring the chart to your screen otherwise. I think that will be easier. 222B, you should be knowing. Let me bring the chart to your screens. Listen, in 222B, what happens is I have a company. This company is making a distribution. It's either making a distribution to equity shareholders or it is making a distribution to preference shareholders. What is it distributing to equity shareholders? It is either distributing debentures or it is distributing deposit certificates. What is it distributing to preference shareholders? Either it is distributing debentures, deposit certificates, or bonus. So, whatever the company distributes under 222B, this or this distribution will be considered as dividend. Again, same thing to the extent of the accumulated profits of the company, whether capitalized or not. This is an MCQ question. APM Limited is a pioneer company in textile industry. At the end of 1819, it decided to distribute deposit certificates to its shareholders, preference and equity shareholders. Total value of accumulated profits was 25 lakhs. Total accumulated profit is 25 lakhs. Mr. A is an equity shareholder holding 10% of the share capital. During 1819, Mr. A received deposit certificates valuing 5 lakhs from APM Limited. Comment upon the taxability of the receipt of deposit certificates in the hands of Mr. A. Now listen, in this case, the company is giving deposit certificates to equity shareholders. The company is giving deposit certificate which is worth how much? The company is giving to Mr. A. Mr. A is an equity shareholder in this case. Mr. A is an equity shareholder in this case. He is getting deposit certificates worth how much? He is getting deposit certificates worth 5 lakh from the company. And he is having how much shares? He is having 10% shares in the company. Okay, so what did I just tell you? Under 222B, whatever the company distributes, whatever the company is distributing to these shareholders, to the extent of accumulated profits, will be considered as dividend. So, what is the distribution which the company is making to Mr. A? Company is making a distribution of deposit certificates worth 5 lakh to Mr. A. Now, what is his share in the accumulated profits of the company? The question says total accumulated profits are 25 lakhs and he has 10% shares in the company. So, what is his share in the accumulated profits, guys? His share in the accumulated profits will be 2,50,000 rupees. So therefore, tell me what will be 222B dividend which you will tax for Mr. A. Whatever distribution the company is making to him to the extent of accumulated profits, whether capitalized or not, that's going to be how much? That's going to be 2,50,000 rupees. So 2,50,000 rupees. This is what we will tax for him under the head IFOS. Okay, so whatever the company is distributing to him, that distribution to the extent of accumulated profits will be considered as dividend. So company is making a distribution of 5 lakh rupees, but up to accumulated profits, it's going to be considered as dividend. So 2,50,000, this is going to be considered as dividend for Mr. A under 222B. Okay, always remember, guys, when it comes to 222A, 222B, 222C, 222D, in these four, you will always find proportionate accumulated profits. Like, are you noticing? I'm not taking 25 lakhs fully over here. I'm taking only proportionate accumulated profits. He has 10% shares. So what is his proportionate share in accumulated profits? Only that much I'm considering. But 222E, you don't calculate proportionate accumulated profits. You take the total accumulated profits. You don't find the proportionate and all. You will not see what is shareholders' share in the accumulated profits. You will take the total accumulated profits as it is. Only in 222A, B, C, D, only in these four, you will take the proportionate accumulated profits. You will take the proportionate accumulated profits only in A, B, C, D. In E, you will take the total accumulated profits as it is. Okay, so this was our entire discussion regarding question number 18. Through question number 18, we have spoken about 222B. So whatever deposit certificates companies distributing to equity shareholders, that distribution to the extent of accumulated profits is going to be considered as dividend for the shareholder under 222B. Understanding? Can I take you to the next question? We have one more question, guys. One more question from IFOS I want to work out for you. Look at this question. Question number 19. Question number 19 is covering several independent situations one by one. We have totally some 6 situations over here. In these 6 situations, we have to say what is taxable, what is not taxable. We have to discuss. Look at the first situation here. MNS Private Limited, a closely held company, issued 12,000 shares at 125 rupees per share. Face value of the share is 80 rupees per share. FMV of the shares is 110 per share. Guys, it is a private limited. So therefore, definitely it's going to be a closely held company. It is issuing 12,000 shares at 125 rupees per share. Face value is 80 rupees, but it is issuing at 125 rupees per share. Face value is 80 rupees, issue price is 125 rupees. So can I say that the issue is at a premium? Yes, guys, the issue is at a premium. And the fair market value FMV is 110 rupees. So are you noticing our conditions are getting fulfilled? We have section 56 to 7B, right? 56 to 7B conditions are getting fulfilled. Number one, the company is a closely held company. Number two, yes, the securities are issued at a premium. The shares are issued at a premium. Number three, if issued at a premium means what? Issue price is more than the face value. And number three, if you see, issue price is more than fair market value also. Issue price is 125 rupees, but what is the fair market value? Fair market value is 110 only. So all my three conditions are fulfilled. If all the three conditions are fulfilled, whatever is the difference between issue price and FMV, issue price is 125 rupees, FMV is 110 rupees. So what's the difference? The difference of 15 rupees per share into 12,000 shares. Total how much? Total is going to be 1,80,000 rupees. This is going to be taxable. Taxable for whom? Taxable for the company. I'm hoping you're aware of 56 to 7B, one of the important sections under IFOS. 56 to 7B says if your company is a closely held company and if this company has issued shares at a premium in such a way that the issue price is above the fair market value. In such cases, whatever is the difference between the issue price and the fair market value, the difference will be taxed as IFOS for the company. So the difference was 15 rupees per share for 12,000 shares. This 1,80,000 rupees will be taxed as IFOS for the company. This was a discussion regarding 56 to 7B. Now coming to the second subdivision, Mr. Arun received an advance of 56,000 on 11 September 2017 against the sale of his house. Due to non-payment of the installment in time, contract was cancelled and the amount of 56,000 was forfeited. Guys, advance money forfeited. Any date that comes to your mind? 1st April 2014, right? Here if you see, assessee has forfeited the advance on 11 September 2017. He has forfeited the advance on or after 1st April 2014. So in such cases, whatever advance money has been forfeited, in the year of forfeiture itself, it will be taxed under the head IFOS. You don't have to wait till the year of transfer. In the year of forfeiture itself, now itself it will be taxed under the head IFOS. This was a second subdivision. Coming to the third subdivision, Mr. Nitin transferred a house property to his son Mr. Raj without consideration. Value of the house is 12 lakh rupees as per registrar. Mr. Nitin is gifting the house property to his son. So first of all, who is the assessee? Mr. Nitin or his son? Under IFOS, who is the assessee? The person who is receiving the gift, right? So his son, Mr. Raj, is going to be the assessee. He is getting a gift from his father. So gift from a father, gift from a relative, it's going to be fully exempt. Irrespective of what the value of the gift is going to be fully exempt. Coming to the fourth subdivision, Mr. Tanmay gifted a refrigerator to his sister's daughter Tanu on her marriage. FMV of the refrigerator is 75,000. First of all, it is refrigerator, which is a personal effect, which is not a movable property. Secondly, sister's daughter. So she is receiving this gift from her uncle. For her, this is going to be gift from relative. Thirdly, it is gift on the occasion of marriage. Any gift you receive on the occasion of marriage, doesn't even matter what is the value of the gift, doesn't even matter from whom you are receiving the gift, it's going to be fully exempt. So any gift received on the occasion of marriage, you don't even have to see anything else. Gift received on the occasion of marriage, you can simply say that it's going to be fully exempt. Are we clear with this, everybody? This is my fourth subdivision. Then coming to the fifth subdivision, on 29th December 2018, Mr. Gaurav received 7 lakhs towards interest on enhanced compensation from the state government in respect of compulsory acquisition of his land. Out of this interest, total 7 lakh interest he has received, okay? Out of this interest, 2 lakhs is relating to 15-16, 3,45,000 is relating to 16-17, 1,55,000 is relating to 17-18. How much interest on enhanced compensation would be chargeable to tax for the assessment year 1920? See, listen, for interest on enhanced compensation, what is the rule? First of all, you will see when was it received. It will be taxed only on receipt basis. So it doesn't even matter that this interest belongs to which year. It doesn't even matter that this interest belongs to which year. It doesn't even matter. What matters is when did you receive it. We have received it on 29th December 2018, which means you have received it in previous year 18-19. In 18-19, it will be taxed. We will give a flat 50% deduction. flat 50% deduction. So the balance 3,50,000 that is going to be taxed. So whatever actual expenditure you have incurred, one by one, I will not subtract the expenses. I will assume all the expenses got covered in this 50% itself. So whatever interest you have received, 7 lakh rupees minus flat 50% deduction, balance 3,50,000 will be taxed in the year of receipt. This interest belongs to which year? That is irrelevant. What is relevant is when was it received. In the year of receipt, it will get taxed. And then coming to the last adjustment, this is relating to section 222E. Remember, I just told you in 222A, B, C, D, you will find proportionate accumulated profits. In 222E, you will not find proportionate accumulated profits. Keep this point in your mind and look at this question once again now. Mr. Pranav has 15% shareholding in TRP Private Limited, engaged in trading business of toys. He also has 50% shares in Pranav and Sons, a partnership firm. Accumulated profit of TRP Private Limited is 30 lakhs. Pranav and Sons had taken a loan of 35 lakhs from TRP Private Limited. Let me explain this concept to you. This adjustment over here is relating to section 222E. Now here in this question, we have this company TRP Private Limited. It's a private company. So of course we can say that this is a closely held company. Then there is this person, Mr. Pranav, and then there is this partnership firm, right? Yes, there's a partnership firm called Pranav and Sons. So we have three entities like this. So TRP Private Limited and Mr. Pranav. Mr. Pranav has how many shares in the company? Mr. Pranav, the question says he has 15% shares in the company. And Mr. Pranav has 50% shares in Pranav and Sons. He has 50% shares in Pranav and Sons. And TRP Private Limited has given a loan to Pranav and Sons. How much loan have they given? They've given a loan of 35 lakh rupees. And what is the accumulated profits of this company? Accumulated profits of this company, the question says, is 30 lakh rupees. This is a question. Now listen. What does 222E say? 222E says if a closely held company has given loan to an entity, in that entity, this company's shareholder, a shareholder who's having at least 10% shares in the company, this person is having substantial interest in this entity. Substantial interest means what? It is a partnership firm. Partnership firm, substantial interest means you have at least 20% profit share. Right, guys? At least 20% profit share you're having. So Mr. Pranav over here, if you see, he has 10%, at least 10% shares in the closely held company he has. And the same Mr. Pranav, in this partnership firm, he has at least 20% profit share. So he has substantial interest. In such cases, if TRP Private Limited is going to give a loan to Pranav and Sons, this loan of 35 lakhs up to accumulated profits is going to be considered as dividend for whom? It will be considered as dividend for Mr. Pranav. So for Mr. Pranav, what will be the 222E dividend over here? 222E dividend over here will be 30 lakhs. This distribution to the extent of accumulated profits will be considered as dividend. Here, this 30 lakhs, will I find proportionate? How much for Pranav? Will I find what is Pranav's share in this 30 lakhs? No. I will find proportionate share of the shareholder only in 222A, B, C, D. In 222E, accumulated profits I will take as it is. Is this also clear? Yes, guys. Perfect understanding? Yes, so this was section 222E. Under 222E, please remember to what does 222E say? 222E says company is a closely held company. There is a shareholder. The shareholder is having at least 10% shares in the company. That same shareholder is having at least 20% profit share in the partnership firm. Now, if the company is going to give a loan to this partnership firm, this loan is going to be considered as dividend to the extent of accumulated profits. It's going to be considered as dividend for whom? It will be considered as dividend for the shareholder Pranav. So this 35 lakhs to the extent of 30 lakhs. So 30 lakhs is going to be considered as dividend for Mr. Pranav. Okay, so that was question number 19 for you. So with this, we are done with all the 5 heads of income. We are done with IFOS also. We are coming to question number 20 now. Are you ready with question number 20? Yes, shall we begin, guys? We're done with total income, we're done with basic concepts, residential status. Then we have discussed about scope of total income. We have seen questions from exempt income, section 10AA and all we have seen. Then we have seen good number of questions from each of the 5 heads of income. Now coming to question number 20. See, question number 20 is a classic question on clubbing. This question is a pure clubbing question. And this question has some 6 adjustments and 6 nice interesting adjustments. Through this question, 99% of your clubbing chapter will indirectly get covered. Okay, we'll have a look at this question. We'll have a look at the adjustments one by one. It's very important. It has come in the examination already. It's a January 2021 question. Any adjustment from this question you might find in your MCQs or in your full-fledged questions, anywhere you might find. Let's begin. During the previous year 1920. So we're talking about previous year 1920. That is, we're talking about assessment year 2021. The following transactions took place in respect of Mr. Raghav, who's 56 years old. So I can say that he is not a senior citizen. What are they asking us? They are asking us to find the total income of Mr. Raghav. So as we go through the adjustments, we'll keep making our necessary notes. First of all, Mr. Raghav owns 2 house properties in Mumbai. Details of these house properties are given. So therefore, he's definitely going to have IFHP, guys. IFHP, let's say working note number 1 we open. We'll open working note number 1 over here for IFHP. Look at what the question says. He has 2 houses. House 1 is self-occupied and house 2 is let out. Rent received per month, municipal taxes, interest on loan and principal repayment of the loan. This is the information which they have given to us. Now with this information, let us try to compute. Let us consider the self-occupied property first. NAV will always be 0. From this, what will we subtract? We'll subtract deductions under section 24. It is self-occupied property. So how many 24 deductions we will have? We will have only one deduction, which is interest on borrowed capital. What is the rule that we have made for ourselves? We will always think about 2 things. We will think about pre-construction interest and we will think about current year interest. Do we have any pre-construction interest here? They haven't given us any date that when the loan was borrowed, when the construction was completed. They haven't given us anything. So no pre-construction interest. We have only current year interest. Interest on loan taken for purchase of the property. 3,50,000 interest we are paying. We are paying 3,50,000 interest, guys. This we will have to restrict to how much? This we will restrict to 2 lakhs. Why 2 lakhs? Assuming loan is borrowed on or after 1st April 1999, loan is borrowed for the purchase of the property. And let us assume construction got completed within 5 years. So this 3,50,000 interest, first of all, I will restrict it to 2 lakh. So what is the loss from house property from the self-occupied unit? From the self-occupied unit, the loss from house property is first of all 2 lakh rupees. Then we have principal repayment of loan taken from HDFC Bank. Where will this go? Where will the principal repayment go? The principal repayment will go to section 80C. So simultaneously now itself I'll open working note number 2 for chapter 6A. So it will go to 80C and 80C will go to which section? 80C will go to section 80CCE. 80CCE says that 80C plus 80CCC plus 80CCD subsection 1, all the 3 put together should not exceed 1,50,000. So we have housing loan principal repayment. Do you remember in the last class I had given you some conditions for housing loan principal repayment? Number 1, it should be relating to a residential house property. Number 2, you have to be careful who the lender is. And number 3, the loan should be for purchase or construction of the property. Yes, it is self-occupied, so it is a residential house property. And yes, the loan was taken for purchase or construction of the property. And the lender over here is HDFC Bank. Bank is covered. So principal repayment, will I get under 80C over here? Yes, principal repayment, I will get a deduction under section 80C. Limiting it to 1,50,000 and all, I will do a little later, but because put together I'm supposed to limit, right? So right now I'm not talking about limiting to 1,50,000. Right now I'm putting it under 80C as it is. Is this adjustment clear till here? Yes. Now look at the next adjustment for house 2. For house 2, the house 2 is a let out property. Rent received per month is 60,000 and municipal taxes paid is nothing. Interest on loan taken for purchase of the property is 5 lakhs and principal repayment of the loan is 3 lakh rupees. What about this? Let out property, guys, a normal let out property this is. So let out property, how will we calculate? We'll start with GAV. Have they given us municipal value, fair and standard rent? None of the three they have given to us. So therefore, I will use a shortcut. The shortcut says I will straight away take the actual rent minus unrealized rent minus vacancy loss, because there is no municipal value, no fair rent, no standard rent. So I'll skip all those steps. I'll straight away do the shortcut. What is the actual rent? Rent per month is 60,000. So 60,000 into 12. There's going to be 7,20,000 actual rent. No unrealized rent, no vacancy loss. 7,20,000 as it is will become my GAV. From this, we subtract municipal taxes paid. Have we paid any municipal tax during the year for this house? No, we have not paid. So the 7,20,000 as it is becomes our NAV. Now, what do we subtract from here? We'll subtract deductions. We'll subtract deductions under section 24. Two deductions we will have. We'll have standard deduction at the rate of 30%. 7,20,000 into 30% is going to be 2,16,000. And one more thing, we will subtract interest on borrowed capital. Immediately we will think about two things: pre-construction interest and current year interest. Even over here, they have not given us any dates and all. So therefore, no pre-construction interest. Current year interest is 5 lakh rupees. This 5 lakh rupees as it is, I can consider here. Right, guys? I can consider this 5 lakhs as it is over here, because let out property, there's no limit on the interest. So what is the net income from house property, from the let out property? From the let out property, it's going to be 4,000 rupees. Everybody agrees? Yes, so this was a let out property discussion. Now, even over here, we have principal repayment of loan taken from HDFC. Can I take this also under ATC? See, is it for purchase or construction of the property? Yes, it is for purchase of the property. Is it a residential house property? But they're not saying anything. They're not saying whether it is a residential house property or not. The lender, okay, HDFC Bank is okay, but then whether it is a residential house property or not, they're not saying anything. They are just saying two house properties in Mumbai. They are not saying whether it is residential or not. Let us assume it is residential. If we assume it is residential, even this 5 lakhs principal, not 5 lakhs, 3 lakhs, even this 3 lakh principal repayment, I can consider under section 80C. Assuming it is residential house property. Okay, guys. And one more thing I want to discuss with you. See, house one, total interest is how much? 3,50,000. But how much interest you were able to give me under section 24? Only 2 lakh. How much interest is still left? 1,50,000 interest is still left. Can I think about section 80EE? Can I think about section 80EEA? See, the loan is borrowed. What is 80EA? If you're paying any interest on a loan which you have borrowed for purchase of a residential house property, then you can consider 80EEA, you can consider 80EE maximum deduction 50,000, 80EEA maximum deduction 1,50,000. But here can I consider? Here I can't consider, guys, because have they given me information that whether the loan was sanctioned within particular period? Have they given me what is the value of the loan? Have they given me what is the value of the house? All that information they have not given to me. So that is why I'm not considering this. But I just wanted to give you a thought that this is also possible had they given us that information. Clear with this, everybody? Yes, this was our first subdivision over here relating to the Mumbai houses. Now come to the second subdivision. Are you noticing? I did not even spend time to read the whole question. I saw it's a total income question. As I read the adjustment, I did not wait to do chapter 6A at the end. As I read the question, as and when adjustments are required, I'll keep doing the adjustments then and there. It'll be much easier, guys. It'll give you a very calm mind. It'll keep you very, very calm, this whole procedure. Instead of reading the whole question and then, opening working notes one after the other, it will not make sense. You will end up spending too much time. This method is the fastest method and also helps you reduce your silly mistakes at least a little bit. Okay, come to the second subdivision. Mr. Raghav, this is a very important clubbing adjustment. Mr. Raghav had a house in Delhi during 10-11. He had transferred the house to Miss Vamika. Daughter of his sister, without any consideration. House would go back to Mr. Raghav after the lifetime of Miss Vamika. So, which means what kind of a transfer is it? Don't you think it is a revocable transfer? It is a revocable transfer because he's going to get back the house after the lifetime of Vamika. See, Raghav is giving a house. He's gifting a house to Vamika, but he's telling Vamika that after your death, I want the house back. So this is revocable transfer. But it is revocable when? It is revocable only upon death. So see, if it is revocable transfer, will clubbing apply? Yes, clubbing will apply. But if it is revocable upon death, now will clubbing apply? If it is revocable upon death, then clubbing will not apply. The transfer was made with the condition that 10% of rental income from such house shall be paid to Mrs. Raghav. What has happened here? Raghav is gifting a house property to Vamika. He is telling Vamika, after your death, the house should come back to me. But Vamika, listen, during your lifetime, whatever rental income you earn from this house, 10% of the rental income you have to give to my wife, Mrs. Raghav. That is what Raghav is telling Vamika. So yes, it is a revocable transfer because yes, it is going to come back. Revocable transfer, we do clubbing, but it is revocable only after the death of the transferee. Therefore, we will not do clubbing. But however, during the lifetime of Vamika, don't you think Raghav is deriving some benefit? Direct or indirect benefit if you derive, even though it is irrevocable transfer, even though I'm going to treat like it is irrevocable transfer. Why am I going to treat like it is irrevocable transfer? Because it is revocable only upon death. So even if I treat it as if it is irrevocable transfer and if I say no clubbing, if the transferor is enjoying any benefit directly or indirectly, there will be clubbing. So here clubbing provision will apply. Are you understanding, everybody? Yes, I'll repeat one last time. Listen carefully. If the transfer is a revocable transfer, then will you do clubbing? Yes, you will do clubbing. But if it is revocable only upon death of the transferee, then you will treat it as if it is irrevocable. And will you do clubbing? You will not do the clubbing. But if it is revocable upon death, but however, during the lifetime of the transferee, if the transferor is enjoying some direct or indirect benefit, here don't you think Mrs. Raghav is going to get rental income 10% every year? So don't you think indirectly Mr. Raghav is getting a benefit? Indirectly is getting a benefit. Therefore, here what will your answer be? Your clubbing provision will apply. Okay, so for this Delhi house, clubbing provision will apply. Rent received by Miss Vamika for 1920 is 5,50,000. So rent received. So even the this Delhi house, we have to do clubbing. We have to consider whenever it comes to clubbing. Always first compute the income in the hands of the person who has earned the income. Compute the income in the hands of the person who has earned the income. That computed income only you should club. Now tell me, who has earned the income? It is Vamika who has earned the income. So in her hands, you compute the income first. What is the rental income she is getting? 5,50,000 rental income she is getting. This will become the GAV number, guys. Then no municipal tax and all. Only 30% standard deduction. No interest number also. So 5,50,000 minus 30% standard deduction, 3,85,000. This is her IFHP. So whatever is her IFHP number, we have computed in her hands. This computed number is what will be clubbed in the hands of Mr. Raghav. Tell me, is this adjustment crystal clear for everybody? Do you have perfect understanding? Have you understood this concept properly, everybody? Is this clear? Yes, guys, we did the clubbing because even though it is irrevocable transfer, why irrevocable? Because it is revocable only upon death. But still, we did clubbing because during the lifetime of Amika, Mr. Raghav is indirectly enjoying a benefit. So I first computed the income in the hands of Amika, and then that computed income is what I clubbed into Mr. Raghav's hands. Okay, now coming to the next adjustment, Mr. Raghav receives the following from SSM Private Limited. He received interest on debentures. Interest on debentures will go to which head, guys? IFOS head. So I'll open another working note for IFOS. Let us say working note number 3 for IFOS. After the second working note, I'll open working note number 3, IFOS. Under this, he has debenture interest. How much debenture interest is he having? Debenture interest of 7,50,000 he is having. Then salary. He got salary of 3,75,000. He does not possess adequate professional qualifications commensurate with the salary received by him. Shareholding of M Private Limited they have given to us. Equity shares and preference shares held by Mr. Raghav, Mrs. Raghav and Mr. Jaykishan, brother of Mrs. Raghav. Now listen, which concept is applicable for the salary? Mr. Raghav is getting salary from M Private Limited. Listen, there is this company M Private Limited. Let me draw it over here. I'll need some more space. There is one company M Private Limited. There is Mr. Raghav and there is Mrs. Raghav. 3 people in the story. Now M Private Limited is giving salary to Mr. Raghav. Okay. Now why is M Private Limited giving salary to him? Because Mr. Raghav is employed over here. However, the question clearly says he is employed without any qualifications. He doesn't have qualifications, experience or knowledge, but still he is being employed over here and he is getting salary over here. Now, in the same M Private Limited, if Mrs. Raghav plus her relatives, if all of them put together have what? Do you remember? Do you know the concept? If Mrs. Raghav plus her relatives put together, if they have at least 20% shares in M Private Limited, 20% what kind of shares? 20% equity shares. If Mrs. Raghav plus her relatives put together, if they have at least 20% equity shares in M Private Limited, then this salary income who is receiving? Mr. Raghav is receiving, but this salary income will be clubbed in the hands of Mrs. Raghav. I hope you're aware of this concept. Yes, guys, if Mrs. Raghav plus her relatives put together, if they have substantial interest in the entity, and in that same entity, if her spouse is employed without any professional or technical qualifications, whatever salary he is getting from that entity, that will be clubbed in the hands of the Mrs. Raghav. Now, in this question, if you see, by the way, what do you mean by relatives here? What do you mean by relatives here? Relatives will include, if I am the assessee, it will include my spouse, my brother, my sister, my lineal ascendant, and my lineal descendant. It will include all these people. My spouse, my brother, my sister, my lineal ascendant, and my lineal descendant put together. Now let us see. Mrs. Raghav, she herself has 2%. Then her spouse, Mr. Raghav, he has 0. Plus her brother and sister, brother of Mrs. Raghav, 98%. Lineal ascendant 0, lineal descendant 0. So Mrs. Raghav plus relatives have how much share? They itself have 100% share, at least 20% shares. See, we will not consider preference shares. We will consider only equity shares. Are you understanding, everybody? Mrs. Raghav plus her relatives. Mrs. Raghav, she herself, plus her spouse, plus her brother and sisters, plus her lineal ascendants, plus her lineal descendants. Total 5 people put together. Yes, it is at least 20%. So whatever is salary income of Mr. Raghav, how much is his salary income? 3,75,000 minus 50,000 standard deduction, guys. You will first do the computation in his hands. What is his salary income? His salary income is 3,75,000 minus 50,000 standard deduction, which is going to be 3,25,000. I will first compute in his hands. This computed number will be clubbed with Mrs. Raghav's income. So because it is going to get clubbed with Mrs. Raghav's income, right now I am calculating Mr. Raghav's total income. Will it appear in Mr. Raghav's total income calculation? No, it will not come into Mr. Raghav's total calculation. Instead, it will get clubbed into Mrs. Raghav's total income. Is this adjustment clear? Have you understood this point, everybody? Yes. Can I take you forward now? Yes, guys. Guys, come on, quickly respond. No, please. Yes, are we clear with this adjustment? Mrs. Raghav, guys, she and her relatives put together have at least 20% equity shares in this entity. In the same entity, her spouse is employed without any professional or technical qualifications. Now, whatever salary income he has earned, the salary income will be clubbed with Mrs. Raghav's income. Because I'm clubbing it with Mrs. Raghav's income, will it be taxed in Mr. Raghav's total income? No, it will not. So therefore, in Mr. Raghav's total income calculation, I'm not going to consider that number. Then look at the next adjustment. Mr. and Mrs. Raghav, they form a partnership firm with equal share in profits. Mr. Raghav transferred FD of 1 crore to such firm. Firm had no income or expense other than the interest of 9 lakh received from such FD. Firm distributed the entire surplus to Mr. and Mrs. Raghav at the end of the year. Guys, what to do over here? What is this concept? This is the concept which this is that kind of a concept which is actually basic. But because it is a part of a complicated question, even though it's a simple adjustment, our brain starts thinking as if it is very complicated. Are you understanding? I'll help you understand. Listen, Mr. and Mrs. Raghav, Mr. Raghav, Mrs. Raghav, both of them, they formed a partnership firm. So there's a partnership firm. They have equal share of profits. Mr. Raghav, he has transferred FD of 1 crore to the firm. Tell me, is it revocable transfer? No. It is transferred to the firm. Most probably it is like capital contribution. Firm had no income or expense other than the interest of 9 lakh received from FD. So Mr. Raghav has given FD to partnership firm. From this FD, partnership firm is receiving FD interest they are receiving. And the firm distributed the entire surplus to Mr. and Mrs. Raghav at the end of the year. Share of profit given to both of the partners. See, listen. Point number 1. Mr. Raghav has given FD to the partnership firm. Nothing wrong. This is not a revocable transfer. This is a normal transfer. Most probably, this is capital contribution of Mr. Raghav to the partnership firm. This is not wrong. Now, whatever FD interest partnership firm has received, this is partnership firm's income. Partnership firm has given this FD interest to Mr. and Mrs. Raghav as share of profit. Share of profit for Mr. and Mrs. Raghav, what will your answer be? It's going to be fully exempt, guys. Share of profit from partnership firm is going to be fully exempt. That's all. End of story. Had it been revocable transfer, then FD interest you would have clubbed with Mr. and Mrs. Raghav's hands you would have clubbed. Had it been a revocable transfer, then you would have clubbed the FD interest in the hands of Mr. Raghav. But this is not a revocable transfer. This is just a normal transfer, most probably like capital contribution. So this becomes partnership firm's FD now. So now whatever FD interest the partnership firm has earned, it is partnership firm's income only. Partnership firm is distributing it as share of profit to Mr. and Mrs. Raghav. This is nothing but share of profit from the firm, which is anyways exempt. Nothing to do. Then, Mr. Raghav holds preference shares in Messrs. K Private Limited. He instructed the company to pay dividend to Miss Geetanshi, daughter of his servant. The transfer is irrevocable for the lifetime of Geetanshi. Dividend received by Miss Geetanshi during the year is 13 lakh. What adjustment is this? Which adjustment is this? This is nothing but transfer of income without transfer of asset. Right, guys? This is transfer of income without transfer of asset. See, Mr. Raghav holds preference shares. He is not transferring the preference shares to Geetanshi. He is only transferring the dividend to Geetanshi. Transfer of income without transfer of asset. The income will be clubbed in the hands of the transferor. So, how much dividend income Geetanshi is receiving? 13 lakh rupees. This 13 lakh rupees will be taxed as Mr. Raghav's income only. So, dividend income 13 lakh rupees. Understanding? He did not transfer the asset. He only transferred the income. So whatever income he has transferred to Ms. Geetanshi, 13 lakh rupees, this will be taxed as Mr. Raghav's income. Fifth adjustment. Now coming to the sixth adjustment, the last adjustment, other income of Mrs. Raghav includes interest from savings bank account 2 lakh. Which head of income IFOS? He is having savings bank interest of 2 lakhs. Immediately, which other section comes to your mind, everybody? Which section comes to your mind? ATTTA. Very good, Ruben. Perfect clarity. ATTTA. Ruben, did you even think about ATTTB? You must have first thought about ATTTB, but then you must have concluded as he is not a senior citizen. So therefore, it's going to be ATTTA. Now, under ATTTA, tell me, is savings bank interest allowed? Yes, savings bank interest is allowed, but maximum how much deduction you can get under ATTTA? Only 10,000 you can get. Then he got cash gift of 75,000 from daughter of his sister. Heights of complication. Cash gift received from daughter of his sister. See, cash gift 75,000. It is more than 50,000. Is he received it from daughter of his sister? Is daughter of his sister, that is niece? Can I call this niece as relative? See, if I receive a gift from my uncle, for me it is exempt. If I give a gift to my uncle, for my uncle it is taxable, because niece and nephew are not considered as relative. For the purpose of gift, who is relative? If I am the assessee, relative includes my brother, my sister, relative includes my brother, my sister, my parents, grandparents, great grandparents, and so on, my children, grandchildren, great grandchildren, and so on, my parents, brothers and sisters, also it will be covered, my spouse's brothers and sisters will be covered, my spouse's children, grandchildren, great grandchildren, my spouse's parents, grandparents, great grandparents, and all of their spouses. This is the meaning of relative, guys. Now, my assessee has received from his sister's daughter. A sister's daughter, see, sister is considered as relative, but his sister's daughter considered as relative. Sister's daughter is not considered as relative. So, therefore, gift from non-relative on birthday, 75,000, more than 50,000, definitely this is going to be taxable. So, under IFOS, where did it go? Here. Under IFOS, we have cash gift. Cash gift of how much? 75,000, taxable. Okay, that's it. Now, come on, let's go ahead and close all our adjustments. If you look at working note number 1, what are our final numbers? We have loss from self-occupied property, 2 lakh. We have profit from let-out property, 4,000. And then we have clubbed IFHP of 3,85,000. So, what is the total IFHP of this assessee? It's going to be 1,89,000. 1,89,000 here. Then IFOS is how much? Add up the IFOS numbers. 23,25,000. This is the IFOS number. Any other head of income? No other head of income we have. So what is this assessee's GTI? 25,14,000. We have chapter 6A, but chapter 6A total ATC is 5 lakhs, but we will restrict ATC plus ATCCC plus ATCCD1, we will restrict to 1,50,000. Total chapter 6A 1,50,000 plus 10,000 is going to be 1,60,000. Total chapter 6A 1,60,000. So what's the total income of the assessee now? 23,54,000, already in multiples of 10. Hence, no need to round off. ATTT I've already considered, Ruben. It's already there. I'll show you. It's already there in chapter 6A. This 10,000 was ATTT only. Alright guys, this was a nice, big, huge bumper question on clubbing. Are you noticing how many adjustments got covered for you? A revocable transfer, irrevocable transfer, transfer of income without transfer of asset. All of these adjustments got done for you through this particular concept, through this particular question. A very interesting question this is. If you're clear with this question, most of it you will be able to handle. Mufi is asking about salary. Salary, Mufi, I will not consider, no, because I just discussed with you that the salary income will be clubbed with Mrs. Raghav's income, because she plus her relatives are having at least 20% shares in the company. In that same company, Mr. Raghav is employed without any professional technical qualifications. So whatever is his salary income, the salary income will be clubbed with Mrs. Raghav's income. So because it is clubbed with Mrs. Raghav's income, therefore there will not be any taxation in his hands. Simple as that. Okay, that is why we did not consider it in his hands. Alright, so this is question number 20, guys. Question number 20 was our clubbing question. What to summarize the question, when you transfer an asset, if it's a revocable transfer, then income will be clubbed. But if it is revocable only upon death, then you will not club. If it is revocable upon death, but during lifetime of the transferee, if you are enjoying direct or indirect benefit, then yes, you will club. Then we discussed after all of this regarding this salary concept we had discussed. Mrs. Raghav plus her relatives are having at least 20% equity shares in the company. In that same company, Mr. Raghav is employed without any professional or technical qualifications. So whatever is his salary income, the salary income will be clubbed in the hands of Mrs. Raghav. Then after this, we discussed that in case this particular point, we discussed that if Mr. Raghav is transferring his income without transferring asset, then whatever income he has transferred, that income will be clubbed in his hands only. And in the whole of clubbing, always remember, guys, one simple point, always remember in the whole of clubbing that you always compute the income first in the hands of the person who has earned the income. That computed number only you club. Okay, so this was question number 20. Now we have the last 10 questions coming to question number 21. Question number 21 is a question relating to set off and carry forward of losses. They've given us a list of adjustments and they are asking us to look at what are they asking us? Compute the gross total income, not the total income. They're only asking us to compute the gross total income. Gross total income of Mr. Farhan and show the items eligible to carry forward an assessment year up to which such losses can be carried forward from the following information given by him. It's a set off and carry forward question. In a set off and carry forward question, I always suggest to students that they should draw 3 amounts columns so that you can space out the answer properly. It will be much neater for you and much easier for you to present in the examination. Whenever it comes to set off and carry forward, I follow a slightly different procedure to handle the question. My procedure is such that whatever losses I keep coming across, those losses I will keep writing in the margin. Whatever losses I keep coming across, those losses I will keep writing in the margin, and towards the end, I handle all the losses together. Okay, same process I'll show you also. First of all, we have loss from speculative business. So I'll write the loss over here. Speculative business loss we have. How much speculative business loss do we have? 12,000 rupees. Then what else do we have? We have income from speculative business. So under particulars PGBP, under PGBP we have speculative business income of how much? Of 25,000. See, right now immediately I will not set off. All the losses I will set off only towards the end. I will not set off right now. All the losses I will think about them only towards the end. Then we have loss from specified business. So we have section 35 AD business loss we have. How much is that? That is 45,000 rupees. Okay. What else do we have? Income from salary. Computed. Computed means it is already after giving 50,000 standard deduction. So we don't have to give any deduction. I will leave enough space for adjustments. Salary is 4,18,000 of this assessee. Then what else? Loss from house property. 2,20,000 loss from house property we have. All losses we'll handle towards the end. Loss from house property 2,20,000 we have. Then income from trading business. Income from trading business, this will come under PGBP. Non-speculative business income, guys. So non-speculative business income, how much do we have? Non-speculative business income, we have here 2,80,000 rupees. Then what else? We have LTCG from sale of urban land. So we have capital gains head. Under capital gains, we have LTCG from sale of land. So definitely this is going to be section 112 LTCG. 112 LTCG from sale of urban land, we have 2,05,000 rupees. Then we have LTCL on sale of equity shares. So we have LTCL. LTCL, sale of equity shares, STT not paid. See, if it is loss, it doesn't matter whether it is 112 loss or 112A loss. It doesn't matter because whether 112, whether 112A, it can still be adjusted against LTCG. Any LTCL can be adjusted against any LTCG. So if it is loss, you don't have to segregate whether it is 112 or 112A. But anyways, just for the sake of your knowledge, STT is not paid. So definitely it's going to be 112 LTCL. How much is the LTCL? LTCL is 85,000. Any LTCL can be adjusted against any LTCG. So this is also done. Then we have LTCL on sale of listed equity shares, STT paid at the time of acquisition and sale. So we have one more LTCL. This is 112A LTCL. How much LTCL do we have? 1,10,000 we have. Then we have STCL under 111A. So STCL under section 111A we have, how much is that? That is 85,000 rupees. These are all current year losses. Then in addition to all this, we also have some brought forward losses. Brought forward loss from speculative business. Tell me, brought forward speculative loss has life of how many years? It has life of only 4 years. It belongs to assessment year 17-18. So it has life till when? It has life till assessment year 21-22. Right now we are in which year? Right now we are in previous year 2021, which means what? Previous 2021 means we are in the assessment year 21-22. So current assessment year is the last year. Yes, current assessment year is the last year. So current assessment year, this loss is still valid. So we have brought forward speculative business loss. We have, how much is a brought forward speculative business loss? 18,000. Remember, this is the last year for this loss. Then we have brought forward loss of trading business. Normal business loss has a life of how many years? Normal business loss has a life of 8 years. So 15, 16 plus 8, it has life till assessment year 23-24. Right now we're only in 21, 22. So this loss is very much alive. We have brought forward normal business loss of how much? Of 12,000 rupees. And finally, we have unabsorbed depreciation. Does unabsorbed depreciation have any life? No, it has unlimited life. Unabsorbed depreciation, we have 1 lakh rupees. Now, if you noticed, I have just seen all my incomes. I have written down my incomes. All my losses I have written in the margin. The losses one by one I will handle now. Whenever it comes to handling losses, we always do current year losses first. Only then we will do the brought forward losses. Always current year losses first. Even in the current year losses, you will always do intra-head first. Tell me, speculative business loss, is intra-head possible? Yes, speculative business loss I can adjust only against speculative business income. I have speculative business income. So against speculative business income, I can subtract this loss fully. I will still be left with how much speculative business income? I will still be left with 13,000 speculative business income. I will still be left with. Then 3580 business loss can be adjusted against what? Only against 3580 business income. I don't have any 3580 business income. So here itself I can say that this has to be carried forward. Then loss from house property. I'm doing intra-head right now. Do I have any income from house property? No. I'll keep it pending. LTCL. I have so much LTCL. I don't have to segregate it between 112, 112A. What is my total LTCL? My total LTCL is 85,000 plus 1,10,000. Total LTCL is 1,95,000. LTCL can be adjusted against what? Only against LTCG. So against LTCG, I will subtract my total LTCL of 1,95,000. How much LTCG I'm still left with? I will still be left with 10,000 LTCG. I will still be left with. So LTCL I have fully exhausted. Then we have STCL. STCL can be adjusted against STCG or LTCG. 85,000 STCL I have. But I will be able to adjust STCL how much? Only 10,000 STCL I will be able to adjust. So capital gains are 0. I still have STCL of how much? I still have STCL of 75,000. Don't you think I can conclude over here itself that this has to be carried forward, because this can be adjusted only against STCG and LTCG, and I have exhausted my STCG and LTCG. So this definitely has to be carried forward. Then so see, listen, I will finish the current year losses, only then I will come to brought forward losses. I still have one current year loss left. I am done with intra-head. I first tried intra-head. I am done with intra-head. Now I will come to inter-head. Now inter-head loss from house property, maximum how much can you adjust? Only 2 lakhs you can adjust. See, don't straight away adjust. First think, against what and all can you adjust? Can you adjust against PGBP? Yes. Can you adjust against salary? Yes. And capital gains anyways reduced to 0. Tell me, against which of the two would you prefer to adjust? In this question, I will prefer to adjust it against salary. Why? The reason, because I have brought forward losses and all. I have brought forward business losses. Brought forward business losses and all can be adjusted only against PGBP, guys. So I will prefer to keep my PGBP for these losses. So therefore, when I have two options, I will choose to adjust against salary income. So I'll adjust my loss from house property, but I will adjust only 2 lakhs I can adjust, because inter-head loss from house property, maximum only 2 lakhs I can adjust. So I'm still left with 2,18,000 salary income. I am still left with. I still have loss from house property of 20,000. No choice. This I will have to carry forward. Now I'm done with the current year losses. Now I will come to the brought forward losses. Brought forward speculative business loss. Yes, I can adjust against speculative business income, but only 13,000 I have. So only 13,000 I can adjust. So less brought forward speculative business loss. Only 13,000 I can adjust. So I don't have any speculative business income left. I still have speculative business loss of 5,000. What will I have to do with this? This will simply lapse. I can't carry it forward to the next year, guys, because this was a last year. So tell me, would it have been wiser for me to adjust this first before adjusting the current year speculative business loss? It would have definitely been wiser. But then am I allowed to do it? I am not allowed to do it. I'm always supposed to adjust current year losses first. Only then I'm supposed to adjust brought forward losses. Is this clear, everybody? Yes. So even though I have speculative business income, even though I know that this is the last year of this loss, I can't adjust this first. I'm always supposed to do current year adjustment first, only then brought forward adjustment. What about brought forward business loss? This I can adjust over here. Brought forward business loss I can adjust over here. And then I have unabsorbed depreciation. Unabsorbed depreciation can be adjusted against any income except salaries. Against PGBP I can adjust over here. These two fully exhausted. So how much PGBP am I still left with? I am still left with 1,68,000 PGBP. So total PGBP 1,68,000. Total salary income 2,18,000. And total capital gains 0. So GTI of this assessee is going to be 3,86,000. This becomes a GTI of this assessee. What are the losses we are going to carry forward? We will carry forward 35 AD business loss indefinitely. Loss from house property we can carry forward for how many years? 8 years. STCL we can carry forward for 8 years. That's it about this question. So through this question, our major understanding was how to handle set off and carry forward question. I hope you understood this method which I've discussed with you. All the losses I'll handle separately. First, I'll finish off all the incomes. Then at the end, I'll handle the losses separately. Okay. When I'm handling the losses, first current year losses, only then brought forward losses. Even in the current year losses, I will first do intra-head adjustment. Only then I will do inter-head adjustment. Perfect understanding? Yes, that is it with question number 21, set off and carry forward question this was.